All right, we are live. Got about 23 people in here right now. Welcome to the, what month is it? May meeting. This is the first time I'm speaking at my own meetup, so I'm like not sure how to be the speaker and run it at the same time. So for those of you who've been here before, we usually take a few minutes at the beginning just to introduce ourselves with our haves and our wants. And so I'll go first just so we can kind of see what's going on, and then we can all take turns. If you don't want a turn, just say no thank you. Do you see the feature down at the bottom right where it says raise your hand? If you would like to introduce yourself and do a have and a want, just click the raise your hand button and I'll go through everybody in order. If you don't want a turn, just don't raise your hand, and we'll go through everybody. So I'll raise my hand and get started here. So basically, my name is Emma Powell, and I'm a specialist in large commercial multifamily. And what I have to offer is a great network and ability to help you identify, find deals, and then find deals that you can invest in. And what I need are more investors. So that's basically what we're talking about tonight is joint venture partners and the investing club model. And we'll talk about more of that later. But what I'm looking for are people who would love to get into a deal, and instead of throwing money at a guru, $10,000, $20,000 for an education course or something like that, we want to get you into an actual deal. So I'm just have a free investment club that we'll get together, we'll look at actual deals, we'll go shopping. And when we get to enough people who want to put in $500,000, maybe up to $1 million between the pool, we can go shopping. We can shop for any deal that we want. We can look at everybody's deal. We will all decide on it together. We'll create a little LLC, and then we'll go and invest in that deal. No SEC involved because we're all joint venture partners. And as long as we keep the group between, say, 5 and maybe a dozen people, we shouldn't have any issues being accused that we're doing a security. So it's great for people who want to be active investors and get their hands on an actual deal and put their money in a deal rather than in some sort of an education. So that's me. I got a couple people with their hands raised. If you'd like to take a turn to introduce yourself, just click on the raise your hand in the lower corner there. Next, we'll have Eloy take a turn.
Can you guys hear me?
Yep.
My name is Ethan. I'm out of Denver, Colorado. I specialize in mobile home parks, but I might be looking to spread my wings a little bit here and do something else other than mobile home parks. So just looking forward to see how good of a fit I can be with other people and see what else other people are working on throughout the nation.
Yeah, grass is always greener. I want a mobile home park and you want a value add apartment. All right, thank you, Eloy. Sam Jones, you want to take a turn?
Yeah. So I am a financial planner who specializes in helping real estate investors. I'm also an investor myself. So I am excited to get in this group, and I think me and Emma have been talking a little while now about multifamily, and I'm excited to kind of dive in and learn more about kind of the syndications and going that route and being a general partner. So that's one of my big asks is to learn, as well as if anyone needs help with tax planning around real estate or cash flow planning, setting up a plan to get into more assets, whatever that might look like. Happy to help as well.
Thank you, Sam. Sam's a local in Salt Lake City, by the way, for those of you who are in this area. All right, we got Alan Corey hopped in next. Alan of Bigger Pockets fame. We had a call earlier today, and thanks for being able to jump in. You want to take a minute?
Sure. Thanks for having me. And I just look at myself. My one is to be Emma Jr. I'm just following your footsteps. So I'm an investor and realtor based in Atlanta. through some partners. We've got some residential commercial, multifamily up to 28 units. And we've got several of those products, and just looking to basically talk to other investors and do bigger and bigger deals and go from there. So pool resources, brains, knowledge, contacts, networking. I think we all want that, and just kind of get creative and let's find a way to get some deals done. So thanks for putting this together, Emma. So it seems like a good group of people.
Yeah, thanks for coming, Alan. And then hold up that copy of that book, that best-selling book that you got there behind you.
Yes. Just published. House Fire stands for Financial Independence, Retire Early. So this focus sort of on the smaller multifamily, the quadruplexes and triplexes and duplexes, sort of how I became financially independent through that product. That's out now. And but now I have my visions on bigger and bigger buildings and projects. But as a realtor, this is what I consult all day on in Atlanta. So if that's your product type and you want to go in the Southeast, definitely give me a call. I can talk to you about that all day.
Yeah, I've noticed a lot of people in the FIRE movement tend to be really, really heavily involved in the stock market, and they're almost afraid of real estate. So I love that you called it House Fire, and showing that real estate really should be a part of a portfolio diversification. It's not that scary. So, yeah. And then what episode of Bigger Pockets are you on? Do you know the number?
466, which was about 2 weeks ago. Yeah.
2 weeks ago. Okay, your phone must be ringing off the hook, man.
Yeah, it's been good. Got a lot of leads. Got a lot of people interested in investing and my style of investing. And so I really come from a cash flow perspective, which is, well, I'll just take a bill in my life, $150 internet bill, and rather than saving $45,000, putting it in mutual funds, which is the FIRE movement of doing things, and then doing a 4% withdrawal rate off that, I save up $25,000, go buy a $100,000 rental that kicks off $150 of cash flow. And so I just went through every single bill. That's what House Fire is. Take every single bill, go buy a cash flowing rental to cancel out that bill, just burn up your bills that way. And, it only takes 5 or 6 properties, typically not expensive ones, $50,000 a year, $80,000 property here, $100,000 property there. Have all your bills covered, and then when I go buy toys. Then I go get a Tesla, and instead of buying a Tesla, I'll buy a rental property whose cash flow pays for the note on my Tesla, and just kind of go through that and pay for my vacations and just use real estate as basically my ATM for whatever bill or expense I have in my life.
Yeah, I love that approach. It breaks it down into manageable little pieces. All right, thanks for coming.
That's a good episode. You should listen to it.
Appreciate that. Thank you, Sean. Is that Sean? Thanks.
No, this is Shauna. This is Sean's wife.
Depends on what day and the time of the day it is.
Yeah, we had some men join us for the women's mastermind last night, and Shauna talked like this and said he was a wife. So, we got Palma next. Palma is my buddy from Chicago and my lease option co-queen. So go ahead, Palma.
Hi, I'm really here just to learn. I own 3 single-family homes as rentals, and want to just learn how to go bigger and hopefully make money to pay off all my bills, like you said. That's really why I'm here. So nice to meet you all.
Awesome. Thanks for coming, Palma. It's always good to see you again.
You too.
Palma was like the first person I met when I went on my real estate investing journey. We took that lease options class together. So let's see, we got Melanie McDaniel next. Melanie is not a local in Utah, but she's here right now hanging out with us.
Hi there, Melanie. So I'm more of a deal sourcer, deal provider. So at some point I'll be here to pitch you, I'm sure. My main bread and butter is multifamily, but because of pricing and cap rate compression and whatever, I'm expanding into residential assisted living and portfolios of homes with lease options. So I will have something soon. So happy to be here. I had lunch with Emma yesterday, and yeah, I'll be on my way to Boise. I'm nomadic. I live nowhere, international sometimes, but I operate online. So I designed my life that way.
I'm trying to be Melanie Jr. I would love to be a nomad. So thanks for coming, Melanie. All right, we got Sean Baxter, followed by Ben Visser.
Yeah, I'm Sean. I'm in the Salt Lake market. I'm just doing single families, but I want to go multifamily or go bigger, smaller, bigger commercial is what I'm really leaning towards. So I got to learn that. But I've kind of just fly by the seat of my pants, and I was like, well, I'm getting to the point that I should really get my numbers and everything like that down before I start jumping bigger.
Wow.
So
That's what we're going to work on, is how to run numbers on deals, because I think it's what holds a lot of people back from investing passively or taking on a deal as a sponsor. Is how do I figure out if it's a good deal or not? So, all right, we got Ben Visser followed by Drew.
Hi. Em and I met her for the first time yesterday. It was a good, quick conversation we had. Was it yesterday or was it 2 days ago? I don't know. The week's kind of gone fast. So I own a few multifamilies in the Wasatch Front. I'm actually primarily invested up in Ogden, and it's just at that point we're kind of looking at how to take the next big step. How to take, I've got some equity that's available. Do I harvest that and use that to grow? What does that look like? And definitely here because Emma intrigued me. There's a lot I don't understand about this part of the real estate world, so I'm here to figure out what that means, what it all means.
All right. Hopefully we can get you some answers, because you're doing really well with the smaller, singles and little multis, and it's not that much different to go bigger. So appreciate you coming. We've got Drew next, and then Jordan after that.
Hey, I'm Drew Walgren, first time in this meetup group. Hi, Emma. Thanks for inviting me in here and connecting with me. So yeah, I just, like Ben here, spoke with Emma recently and joined the group. But haves and wants, let's say I have capital, have lending partners, have the team, the machine is well running. I'm always looking for deals in industrial assets. So not sure what kind of group exactly. We have people connected with the right kind of brokers there, but we operate really in single tenant net leased industrial assets. So always looking for opportunities there. And nice to meet you all.
Thanks for joining us, Drew. I'm just going to announce this right now instead of at the end. Drew is our speaker next month. And so he's going to teach us all about syndicating on industrial properties, which I think is something that everybody talks about doing, but we don't really know that many people doing it. So Drew's going to pull back the curtain for us and teach us how to evaluate those deals, how to find them, how to put them together and make them happen. So thank you for coming, Drew.
Yep.
We'll see you again next month. All right, Jordan, take it away.
Hello. I'm Jordan Atkin. I run a small development firm here in Salt Lake City, Utah, Tag SLC. I got I think your invitation on LinkedIn, so I appreciate this. Is my first meeting, so I appreciate the opportunity. I might be able to connect with Drew on this. I actually have a 1031 exchange. We're coming out of a 21 unit apartment building in the Marmalade neighborhood, and that I'm closing on July 1st. We'll be trading out of that $5.5 million sale with quite a bit of equity, and love rolling out a 4-cap multifamily into 7-cap commercial deals. So we're buying an IHOP next month, coming out of a 5-plex, and would love to find some deals.
Awesome. And Jordan introduced me to my current architect for the project that we got going on. And he had one of your projects on the whiteboard when I was in there the other day, and I'm looking at it and I'm like, is that the one that I'm bidding on? Jordan's not buying my project, is he? Unfortunately, it's not. But Jordan does a lot of development around Salt Lake City and can hook you up with a deal if you're interested in going that direction. So rest now or forever hold your peace. If you want to do your haves and your wants, go ahead and click the raise hand button there at the bottom, and I will call on you. And if not, we will get started. All right, Robert, go for it. And Adrian. Robert Beninati. There you
Hey,
are.
how y'all doing?
Good to see you again.
Yeah. I'm Robert Beninati. I'm out of New Orleans, Louisiana. Lived here all my life. But I have been in renovation construction for 30 years. Been in management, property management, development, asset management for the last 10. Been investing in actually storage facilities and yeah, just still looking for multifamily. Just most of it doesn't make sense. But I'm definitely eager to help add value wherever. Also looking at mobile home parks. So, and then personally, I've flipped homes. I've bought mobile homes. I've bought residential multifamily, but looking to scale into bigger either mobile home parks, more storage facilities, or multifamily properties.
Nice. Every time you call me, I'm maybe on speakerphone. Troy's always like, "Is that Robert?" He knows your voice really well. He always wants me to say hello, so he's over there like, "Is that Robert?" Yep. So thanks for coming, Robert. And then Adrian Donner, go ahead and fire away.
Hi, thanks. So I'm still new to the investing game, fairly. So we are in a house hack that's a disaster right now, under construction. It's so much fun to live in. And I'm a residential real estate agent here in Utah, and dabble with the commercial side of that. And then in-house, we have Amy Johnson, who's our developer. And we have a lot of money raising that goes on in here. And yeah, it's a lot of fun, lots of deals that come through. So if you have money and want some other deals, we have some options there too.
Yeah, you guys are like a money raising machine over there. You have so many projects. So, and Adrian's part of our, we have a small women's mastermind group here in Salt Lake City, and Adrian's part of that. We get together once a month and just talk accountability, and it's been really fun to watch what everybody's been working on the last couple of months, and you know how much progress everyone's been making. It's kind of like having a workout buddy. So whether you're here tonight in person or you're watching this later on the recording on YouTube or Facebook, reach out to the people who have spoken, because a lot of you want to talk about self-storage, wants to get in a mobile home park, the mobile home park wants to get in a multifamily. You know, we've got people in industrial who are looking for money. We've got people with money looking for a deal. So this is how we make things happen. And this is the whole point of this meetup. The part where we have the speaker who's talking about this new educational thing, that's fun and everything. That's a good reason to be here. But if you've been at this for a while, this stuff just starts to get really repetitive, and you're really here for the networking. And so I just want to encourage you to reach out, to connect, go through the Facebook group, or just private message each other. Or if you want to try and get a hold of somebody that you see here on this video, just reach out and I'll try and connect you if you can't find them on your own. So this networking is really, really the value of this group. So thank you everybody for coming. And I'm going to jump right into it because we have a lot of stuff to cover in this topic. So I'm going to share my screen. I'm going to start out with this questionnaire. Let me know if you guys can see this questionnaire. Everybody can see the screen? Okay. Perfect. So basically, what we're going to start out with is just talking about joint venture partnerships. So for those of you who have been doing this for a while, you recognize that there's a difference between a syndication that includes limited partners and a syndication that includes joint venture or general partners or managers. And so when the Securities and Exchange Commission regulations come into play are when you are including what's known as a limited partner in your group. So limited partner would be somebody who's putting money into a deal and nothing else. They're not doing any work, or they're not contributing in any material way. They have no choice over how the money is spent. It's like buying a stock. You put it in, or like an IPO of a stock, you put it in and the business gets to spend it however they want. And then you're just basing your returns off of what the business is doing. You can't call up the CEO, you can't vote, you just have really no power. It's totally passive. And so the Securities and Exchange Commission was basically brought about to protect limited partners from predatory managers. And so there are a lot of rules to follow when you have limited partners, and the legal paperwork and documents that you need to do can be sometimes quite expensive. And so it tends to be a joint venture tends to be attractive for a couple of different reasons. One, either people don't know how to get a limited partner and they don't want to pay for it, or just their network doesn't have a lot of limited partners in it. That's kind of the boat that I'm in, because I hang out with all of you who are entrepreneurial. You want to be doing deals. Even if you have cash to put in a deal, you still want to have some level of control. And you want to be learning. You want to be building your resume and being around people who can help you grow your business. My goal really is to be more of a passive limited partner. It's like people talk about getting into this business because we want more free time, we want more passive income, we want to spend more time with our friends and our families and all have goals. But when it gets down into it, it boils down to how much control do you want to have, and having control oftentimes means that there's some work that goes along with it. So that's why being a manager or joint venture partner is oftentimes more attractive to people who are more entrepreneurial. And it can still be quite passive depending on how you structure it. So I'm going to just jump right into how you go about finding your joint venture partners, and then how you have the conversations with them once you've decided to do a deal together. So I'm just going to tell you some stories about how I found my partners, because we all learn best by stories. So because you are not raising funds from limited partners, you are allowed to advertise generally for joint venture partners. If you've ever followed me on LinkedIn, you'll see that down under my tagline, I will usually have my joint venture opportunities that are currently available. I will post about them openly on social media. I will make videos about them. I'll talk to my friends, neighbors. I can talk to anybody I want, because what I'm looking for is a business partner. And there are no rules on who I can talk to about looking for a business partner. So I'm very public about it, both in person and on social media. And so the best way that I've found to meet people who are interested in being joint venture partners, because they have to have money. A lot of people will reach out and say, hey, I want to do a deal with you, but I don't have any money. They want to be mentored. They want to come along as an intern or something like that. But what you're looking for in a joint venture partner is typically somebody who has a significant amount of cash to put into the deal. Now, when we first start out, like, I don't know anybody with $300,000, $400,000, $500,000 to put into a single deal. But once you start putting it out there, you'll be shocked who you run into. I would say the most common that I run into is like the 100 to 200 range of people who are seriously looking to go on a joint venture. I mean, I could trip over them any day of the week who want to get actively involved and have maybe 100 or between 200. What I'm really looking for are people sometimes in that 250 to 500 range, because that gives you a lot of power coming into a joint venture when you're bringing in that much cash. Now, we'll get to this later, what you do if you don't have that much cash, but you still like to be in a joint venture partnership yourself. But to start out with, we're going to talk about how we find and meet those people who are already in our network, who are higher net worth individuals. Typically, they're not interested in being a limited partner, so you're going to find them at real estate investing clubs. You're going to find them at conferences. I've met a lot of them at conferences. And a lot of my partners I've met strictly over social media, where I just put it out there. Like, who wants to talk about having a joint venture deal? And sometimes I'll even put a little deal up that I'm looking at, or maybe just put under contract. And I'll say something like, hey, we're looking at doing this deal. There's a $200,000 minimum. And so when people contact me, they don't even reach out and private message me unless they have at least 200 grand. And even if that deal is not a good fit for them, now they're in my Rolodex. So next time I have deals, I can start pushing it out to everybody who's ever responded to something like that, and just building the network. And it's just like any other network. You're going to meet a lot of people. You're going to forget who a lot of them are unless you talk to them regularly. And you're going to want to have some sort of way to organize it. Just start out with a spreadsheet. Put their name, contact information, maybe the state they're in, how much cash they have to invest, what kind of projects they want to be investing in, and how much money they want to put into a single project. And that's just conversation after conversation. And then I just follow up with them occasionally when I have something. I try not to bug people a lot with a lot of email marketing. I send stuff out when I have actual deals and email everybody on my list. And then we'll have more conversations. People aren't just going to jump in and do business with you because they met you at a conference once. So there is a relationship that needs to develop. But if you have deals, you will attract people with money. I would recommend attracting the money first and then start bringing deals to your existing network. It's very difficult to find a great deal when you are under-networked, because even if it's a great deal, if you don't have the people to take it down, you're going to get stuck with hard-earned money and you're not going to be able to close because you can't raise the capital. I have people come to me all the time saying, hey, Emma, I've got a great 7-plex in Atlanta, Georgia. I put down $50,000 of earnest money. I'm looking for someone to come in with $375,000 to partner. Do you know anyone? And I'm like, I struggle to find people who are anywhere above that 100 to 150. And so a lot of times I can't really help. I certainly would hesitate to send a deal from somebody I don't know very well, that I haven't personally vetted out the underwriting, out to my network. Because even though you're a joint venture partner and you're expected to do your own due diligence, if it comes from someone you know, there's some sort of feeling that they've maybe vetted this deal. So if I ever do share that with my network, I always say, I don't really know this person. I have not vetted this deal. I just want to make the introduction, and it's up to you to do your own due diligence. So that's how I meet them, and that's how I get a decent deal flow to send to them, so that we can continue having follow-up conversations. Because if I never send them anything, they're going to figure out who I am, right? Because then I'm just another person they met at a conference somewhere. So it's good to stay top of mind there. So that's how I meet them. That's how I keep track of them. It's how I continue to foster relationships with them. And for me, social medias and conferences have been a huge, huge part of that. So the next thing we have to do is I'm going to find a deal. We're going to make sure that we have the capital committed. I'm usually going to show them a nice, strong underwriting spreadsheet so that they know that I've done my due diligence. If I've been to the property, I'll have a bunch of photos that I've taken, put it into like a little Google Slides is all I use. So I just get on Google Slides with a little template and put in some basic information, and then I have at least an executive summary to share with people. And then as we get into the deal, we'll do more and more due diligence together, because I'm not attracting a limited partner. I'm attracting somebody who wants to be hands-on in the deal. So if you don't have all the research done right at the beginning, you are going to continue to do research together as a team. And that's a good opportunity for you to be working together to see how you like each other, how you're communicating, how you're getting along. And if somebody with money also has complementary skills to what you're doing. So let's take John, for example. I met John at a conference, and he looked at my deal and he said, "Your deal sucks." But you know, we kept following up, and eventually John looked at some other deals in the area and some other deals that I was sending him. John had a little bit of cash that he wanted to put in, was looking to get into a deal, but John is really good at underwriting, and I'm not. I don't really enjoy it that much. And so John came in and offered the underwriting and to manage the financial, not only the financial due diligence, but just the financial asset management, which was a skill that I really needed. And John's ended up being just a powerhouse workhorse in that deal. John doesn't enjoy it either. Yes, you do. I know you. Not enjoying the financial asset management, but he certainly does enjoy the financial underwriting and the due diligence for sure. You totally geek out on that stuff. But it's just really nice because that team came together very well, where we have a construction manager who lives near the site, can go out there. They had some cash to put in. They're looking to get their feet wet in their first real commercial deal. And then we have another partner in that deal who basically talked John into it, who takes care of the day-to-day management, making sure the bills are getting paid. Because I'm really not a very detail-oriented person. I like to go out and meet people, find deals, put people together, make stuff happen, and then I'm not so great at the at a lot of the detail management stuff that goes in after that. So it's important to find out not only if they have money, but if you have some complementary skill sets. If you can be picky enough that you can say you have money, but we're too similar, that's always a great place to be if you have choices of who you're going to bring in. But it can be really tricky from a psychological standpoint, because it'd be like, hey, you have money and I'll use it if I have to, but I'm really looking for somebody who's a better fit. So just hold on and I'll let you know. So it's really tricky to balance those follow-ups with people who have cash, they're ready to put it in the deal, but you're really looking for either somebody who has more money or who is a better personality fit. So just be aware when you're having those conversations that it can get awkward, and you need to kind of figure out how you're going to handle it before it happens. And for me, I usually just say, we're going to choose the best fit. It creates a feeling of scarcity, and we are evaluating a lot of interested people, which it's I'm at the point where that usually is the case. When I was first starting out, I was like, anybody who had money, you were just going to make it work. And that brings me to my next point. When you're working together, especially if you've got some people in the deal that you don't know that well, and you didn't really have a lot of options, because not a lot of people are throwing money at you. And so you can go into that and say, we are going to learn how to communicate together, and we're going to learn how to work through our problems. And so there's a lot of communication study, business management study, reading body language, tone of voice, cues, how to figure out how to make sure people are feeling comfortable, everybody's feeling heard and validated. It's just like a marriage. You really need to brush up on your communication skills if you want to make a partnership work. And for me, I would say that's been the #1 thing that has made my partnerships successful, because even if we run into problems, we're always able to come together and discuss what's going on like adults, because at least somebody in the room has the communication skills to mediate any conflicts. And so if that's not you, make sure there's someone on the team that can do it. And if that's not you, I would say, again, #1 skill to have to make these partnerships go smoothly is to have strong, mature communication skills. So tons of books out there. If you're not good at it, get good at it. You will thank me later for being able to navigate some difficult situations inside of your partnerships. So does anybody have any questions so far before we move on to the legal considerations? You can use the raise your hand button, or you can just take yourself off mute and start yelling at me. I've got kids, I'm used to it. So, all right, so this is just a little questionnaire that my attorney sent to me when we are considering doing a deal with somebody. And these are some really important questions. I have filled this out a couple of times with different partnerships, and when we do send this to the attorney all filled out, the attorney's usually like, wow, this is great. They're able to draft the operating agreement from this questionnaire without having to ask us a ton of questions. And it saves us a lot of money on legal bills. It also gives us a chance as a group to talk together, get to know each other, figure out how this whole thing is going to fit together, because I may have certain skills that aren't needed in a deal because there's somebody else in that partnership who's better at that than I am. But on another deal, I might be the strongest in that. And so you could be filling in different roles depending on your capabilities, because we all have different competencies in addition to our core skill. And so this, going through this questionnaire, even though it's legal, really gives you a good personality check, and it really gives you a chance to interact on some serious stuff. Like, it's getting real now when we get to this point. So we're going to go over the contributions, who's contributing what, and I will show you a spreadsheet of how we figure out. So I usually just skip this first one, and I'll insert a copy of the spreadsheet table, and I'll show you in just a moment. And then we're going to go over the distributions, draws, salaries, figuring out who's going to get paid. Are we going to have distributions from the get-go? Are we going to wait for 6 months? Are we going to have a certain hurdle that we need to get over, like our gross occupied income has to be a certain level before we pay distributions? And you're going to decide, does everybody get paid evenly, or are we going to pay out on an equity split? And no, there's no right or wrong answer to any of these. It's just whatever the partners who are in the discussions will discuss and agree on. And if you have somebody in here who's just really being difficult and you really can't come to an agreement on it, that's something like dating. This is like a dating opportunity. Do I really want to marry this person if even this conversation is painful, if we can't come to an agreement on what's going on even in this legal conversation? This is where you really get a good feel for people. So it's doing double duty as a psychological test and getting your legal stuff out of the way. So you're going to have a managing partner, or maybe co-managing partners, and these are the people who handle just the day-to-day stuff. They're going to make the fiduciary decisions on behalf of the entire group, and then you might have another manager who's really doing the day-to-day, paying bills, making sure that the checklist gets done, the project manager. So you could have one manager, or you could have a fiduciary manager and a project manager, and it's just up to the team to split that up according to what works. When you have a larger joint venture, I would say more than about 5 people. More than about 5 people, I've heard some securities attorneys tell me that starts smelling like a syndication, a securities syndication, that if you have more than 5 people, can they all really be doing a viable job? And so it starts to draw the attention of the state SEC regulators if you get the joint venture too large. But I would say usually less than a dozen is fairly safe. So somewhere between 5 and 12 is where you have just make sure everybody has a real job and nobody's in there just for money and hardly doing anything. If you do have a larger group, this department is a great way to handle that, because you can say these 2 people over financial management, these 2 people over construction management, this one person is going to be over the property manager. And in one of our groups, the way we work it is is I get to be a little bit over financial, a little bit over construction, but then I have a financial manager and a construction manager separate, and I'm basically half a person on both of those teams, and so that I'm helping out each person with what they need. And then you're going to have a lot of voting things that you need to decide on. And this helps to frame it. Do you need a majority, a super majority, or unanimous? And so we say, okay, sale and refinance needs to be unanimous. Expenditures over a certain amount, we set that, what that amount is. Is it $2,500? Is it $10,000? When do we need to come together and make a group decision on what we're spending? Like, I don't know, the gas line explodes and it needs a major repair. You need to go in and work on that together. How many bids are we going to get? Are we going to clear it? So working as a team when there are huge decisions like that to be made is where you're going to have this section in there. And then arbitration. If there's a problem that you're dealing with that is really insurmountable and you need to bring in an outside arbitrator, how are you going to handle that? What state are those arbitration meetings going to be held in? Are they going to be binding or non-binding? And if they're unable to be resolved and they're non-binding, what type of legal actions would the team say is appropriate? And so even sometimes the operating agreement will say you can't have a lawsuit because arbitration is binding. People will bring lawsuits anyway. So make sure you're very thorough in this situation, but always know in the back of your mind that anybody can bring a lawsuit even if the OA says that they can't. So I think it's better to just make provisions for what's going to happen in the event of a lawsuit ahead of time, just so a judge has this in front of him if he has to be looking at the situation and he knows what the original intent was, rather than just saying, oh, it's binding and we can't have a lawsuit, because then that leaves you unprotected. People can always bring lawsuits. Disagreements and deadlocks. This is a huge one because sometimes you'll have, say, 4 people in a group, but they're not going to have equal equity. Are you going to give each person one vote? Or are you going to let people vote according to the amount of equity that they have? If somebody owns a huge chunk of the business and they're deadlocking everything, how are you going to handle that? And so what we typically do is we'll say we get a 1-to-1 vote, and then if there's a deadlock, then we're going to vote along equity lines, and then if we're still deadlocked, then we're going to move on to outside arbitration. I have never run into that problem yet, but you need to keep doing this long enough, and I'm sure it'll happen eventually. And then again, interrupt if you have any questions. I can hear the little sound when the hands go up, or like I said, you can just unmute and start yelling at me. I'll try to have longer pauses so you can hop in if you have any questions. All right, capital calls are a massive sticking point. So just get ready to spend some time on this one. I would say the market way of handling capital calls is that everybody is required to contribute according to their equity portion. So you need to raise $100,000 and you own 10% of the deal. You only have to bring 10% of that $100,000. If you do not bring it in, then one of the other members can loan it to you, and you will be paying it back to that member at a very high rate of interest, typically between 8 and 12%. And this is very normal, and you will have joint venture partners push for this because it is pretty standard. But you have to be aware that there are other options. You can say that all partners have to contribute equally. You contribute a fixed amount, that each partner may have a different fixed amount. We can also make the contributions voluntary, like in one partnership or 2 partnerships, we have it where it comes in, it's a loan to the business at a reasonable rate of return, because we don't want to change the equity portions if somebody puts more equity in, because that's going to dilute the other portions. So sometimes people will say, I'm just going to make a loan to this business, and we make the interest rate high enough that it's motivating, but not so high that it becomes unaffordable. So you have a lot of options here. Don't just go with what somebody gives you and what they say is market. Can you penalize people if everybody puts it in but then the other person doesn't? Should it be a loan at a high rate, or should they just be diluted? That would be adjusting the capital accounts and who has how much equity, and that would require an amendment to your operating agreement, because as you see at the top here, we're going to put the splits in and who has this contribution. So you can adjust those later. It just takes a meeting of the LLC, you put it in the minutes, you update the operating agreement. It's kind of a pain in the butt, but it happens. It needs to happen if you fall short on money and you underestimated, or you had an unexpected expense and you need to raise some capital. Some of the other options are that you can go raise outside capital, bring in a new partner, which will be dealt with a little farther down in the agreement. And you might say that you can go raise money on private notes, in which case you might have the partners decide what's the maximum raise that's allowed, and that has to be approved unanimously if you're going to raise notes. So this questionnaire really helps you go through and decide how you're going to handle these things beforehand, and some of these serious issues that really could cause a lot of damage to a partnership. You have plan A and plan B already spelled out. So here's the one that everybody asks about. It's really not that big of a deal, but they're like, what if you die? What if you get a disability? We just go through the succession. Their heirs do not have rights to the business. We will buy them out. If someone dies, we can buy out the heirs. And so you're not going to get stuck with doing business with someone's ex-wife or someone's widow that you don't want to be doing business with because you didn't take care of this. So there's going to be a buyout. You're going to evaluate it. Are you going to do an appraisal, a broker's opinion of price? Are you going to do a business evaluation? Decide how you're going to evaluate those shares. And then if you're going to buy out that partner, or in my case, my husband is my business partner, and everybody I do business with knows that he's the majority holder of our LLC, and that if something happens to me, in that case, some of my partners have said, yes, your husband can just come in and fill your shoes because he's already our business partner. It's just you're the acting manager of that LLC, and they like him, they know him, and they would be fine doing business with him. So they could, in one LLC, we just have it in here that if something happens to me specifically, that my husband will step in, but everybody else will be offered a buyout, not offered, forced to accept a buyout for incapacity. Then you have the dissolution. In real estate, it's pretty easy because you're going to sell the property. And this would be like in instances where somebody wants to force a sale because the project is not going well, the partners are not getting along. First deal I ever bought, it was that the partners just weren't getting along. And they had already made an agreement of how they were going to handle that in case they wanted to part ways, which was to force a sale of the property. And the people who didn't want to sell, basically, they went through their resolution process, decided to sell, and that's how I got a hold of it. It was kind of like an amicable divorce because they'd already determined this beforehand. So the admission of new partners, this would also fall under capital call, because if you need to raise new money and you want to dilute the partners by bringing in a new one, this is the way. Does it have to be unanimous, majority vote? How do you handle the buy-in? And then how are the capital accounts going to be adjusted for the equity for the new partner? You may also want to bring a new partner in and adjust your equity stakes, because you just realize that you're missing someone in your group, that there's a skill that you need that you don't have, and so you're going to invite somebody in. I would say that the first thing that you should do if you're missing a particular skill is to just hire someone, because if you think hiring someone's expensive, try a partner. They'll eat up a huge amount of equity. But if you're really strapped for cash, sometimes that's the only option, and you can have someone come in just to help out in areas that you're weak and where you're struggling. And then ownership of the assets. In real estate, again, this is very straightforward. There's not a lot of equipment. It's just we own the building together. We co-own it. It's not anybody's individual LLCs. And then there are common valuation methods. And usually for real estate, we just choose to either go by a broker's price opinion, and if there's a dispute over the valuation of your shares to be bought out, or if you're going to be forced buyout, being kicked out, if you dispute that, you can always have the business pay for an appraisal. And so those are some of the issues that we go through, and we send those to the attorney, and then he sends us back the first draft of the operating agreement, which we can then all review as a team. We'll usually go through a couple of tweaks and renditions of red lines, and then once it's all stable, we can sign it. And because we've gone through this beforehand, it's usually pretty quick, and not a lot of red lines, and the attorney costs can be kept pretty minimal. I would not recommend going into a joint venture with somebody unless you have all of these things taken care of. I've been in other businesses, not real estate, before, where the partners didn't even bother forming an LLC. There's no operating agreement, and they've ended up in court, and they were great friends, and now they're blocked on social media, and I can't talk to one about the other. And I've seen these kinds of ugly things happen because we just didn't have our ducks in a row. And as you can see from this questionnaire, it's fairly simple. It's really not that hard to get this stuff drafted up. It's going to cost you maybe $2,500, and that includes the entity formation, the operating agreement. They're going to file everything for you. They're probably going to be a registered agent for $2,500. In a real estate deal, that's just pennies. So don't leave these things to chance, and make sure that you're getting taken care of this. And then as far as attorney review goes, what we always do, and you have to remember, none of this is financial or legal advice. I have a business degree and a bunch of kids. So I'm not in the financial services. I am not a legal person. I'm just telling you how we handle it and the advice that we've gotten from our own attorneys, just by way of sharing stories. We sometimes will have an attorney for the entire business, and then each of us will have our own attorneys. And so, for example, when we draft an operating agreement, our company attorney will draft it. They don't represent any of us individually. If they do, they have to disclose that there's a conflict, that they're representing me, but they're also writing an operating agreement for the company. And as long as everybody's okay with that, you can do that. Sometimes we'll just get an attorney just for the company. And then when the final OA is ready to go, before we sign anything, I will send it out to my attorney to review, and he may have a couple of suggestions that are material or immaterial. And then that's going to be an extra fee that I'm just going to absorb. It's usually between $250 and $500 for me to go and have this evaluated. And then we might have another round with our company attorney if some of the things that they've asked for are material and need to be changed again. So that's typically how we structure our legal, but there are obviously variations of how you're going to involve an attorney and at what point you're going to bring that attorney in. And usually the company will pay for the company attorney and the documents drafting, and then you personally will pay for your attorney to review everything before you sign it. You have to have this operating agreement signed before you can open a bank account. And the reason is because the business banker needs to see who the person is on the operating agreement that has the authority to do the day-to-day activities to open the bank. And so this is something that you want to get done sooner rather than later, because when you're ready to start pulling money into a deal, or you're getting close to closing and you don't even have a bank account yet, it makes things very difficult. So what we'll typically do in that case, if it's taking us a long time to find that last partner and raise that last little bit of cash, is we'll have people start depositing money into the title company's trust account while we're working on getting this all sorted out. At least then the money's there, and people feel like they're safe to go. But I would never close on a deal until this operating agreement is signed. I would get an extension, and just make sure that this happens, because you're just going to be sorry if you don't have this stuff taken care of ahead of time. Okay, so that's it for how to find them, how to deal with them, and with some of the legal considerations. Does anybody have any questions about that before we move on to the financial splits? Okay, I'm going to share a new.
Quick question, Emma.
Yeah, go for it.
Is this something you do with, like, even just like a partnership that you do, like go through this amount of detail? Or is it only kind of more of these bigger deals?
Do you mean if, like, I'm going to partner with somebody on a fix and flip or something?
Sure.
A fix and flip, because it's a smaller deal, typically can be handled if you have an LLC and I have an LLC, then our LLC can just draft a joint venture agreement between the two of us. And I bought a joint venture template from my attorney. I think he charged me like $500 for it. I can just reuse it over and over and over again. And so when you're buying documents that you want to reuse, just make sure that they're a little bit more boilerplate and your attorney knows that it's going to be a template. Another template that I bought from my attorney was a private note, so that I could have people loan me earnest money, and I can just recycle the note, or I can have people loan me money to be doing, instead of bringing in an equity partner, you can actually bring in private note partners and have those notes ready to go. Now, bear in mind, a private note partner, you are offering a security. So if you have a private note partner in there, you need to make sure you follow the state SEC rules about how to handle private notes in your state. If you are in multiple states, because you have an owner here, an owner there, and a property there, just follow the rules of the most strict state. What you're typically going to find on private notes are that they're written for 9 months or less. They do not need to be registered as a security. They are still a security, but you don't need to go through registering them. Most states will allow a 9-month extension or 9-month extension increments, but you would need to be re-signing that note every 9 months to avoid having to register it. Other states have some weird things, like Utah says something about $50,000 increments doesn't need to be registered. I don't even know what that means. I asked my securities attorney about it, and he was like, I don't even know what that means. Like, so if it's like $100,000 you don't need to register it, but if it's $101,000 you do. I don't know what that means. So sometimes you need to get some clarification, but it's usually on the state website for the SEC. So just watch out with the private notes and make sure that you do it correctly. Most flippers I know who are flipping houses from their pool of private money are doing it illegally. It's very, very common for them to raise money in their pool and they just keep reusing the money over and over again. You may even be on title and they may even gone through a title company and you may have an official note, but because they're increments of 9 months, it's open-ended, they should have registered it. So just follow the rules. I know too many people who have gone to jail for this stuff. They've had their ability to raise money forever prohibited. Like the SEC will catch them on something and they can no longer raise money, which
Emma, we can't hear you. If you can hear me, we can't hear you.
We can't hear you. Yeah.
You're on mute, Emma.
I just put it on mute. Can you hear me?
Yes.
Yeah.
Okay. I had to just change out to my other microphone, so I put it on mute for a second. Okay, where did we leave off? Did I tell you that the state SEC is coming for you because they got nothing better to do? Did we get to that part?
You were telling us that you know lots of people who were in jail and they can't raise money anymore.
Okay, and the state SECs had a lot of their privileges or a lot of their responsibilities rather taken over by the federal SEC. And so state SECs really do look at this stuff. You might think that you're below their notice, and maybe you're below the notice of the federal FEC, but the state ones are going to be the ones that you need to be watching out for to make sure you keep your nose clean on this kind of stuff. So I'm going to show you the partnership splits table. Yes, if you want a copy of the partnership considerations, it is copyrighted by my attorney. I can share it, but just bear in mind that it is copyrighted. And then this spreadsheet that I've created is also copyrighted, but it's copyrighted by me, so I don't care who uses it. So if you want it, just go ahead and ask for it. So I'm just going to run you through. You don't have to use this spreadsheet. I can show you a copy that my partner has drafted up for another deal that we're doing, but it has people's names and actual financial information, so I can't share it. It's pretty similar to this. It started out super, super simple. John, you'll notice that the first time you saw this, it was a lot simpler than this. And I just keep filling it out, fleshing it out, building it out, each partnership that I do, so that it gets to be a little bit more automated. So you'll see here, for example, we're going to just start with putting in the partner names, only type in the white boxes. So we're going to say Emma in one, and John in the other, and Palma in the last one. And then these partners, we don't actually have. Maybe they'll come in later, maybe they won't. You can delete these rows if you want, but if you're not comfortable with spreadsheets, you might just want to just leave them there. And you can see how it's automatically filled in with Emma, John, and Palma in all of these spots. So it'll fill it out for you. The next thing that we typically will decide is, and this is something that we do in syndications that is not typically done in a joint venture. And we're certainly not going to give this stuff to our attorney. We're going to give him this final split. This is all our attorney's going to see, are the names and the final splits. Because we're not going to show him how we figured this stuff out. Because we're saying, okay, managers are going to get, say, 40% of the deal. And people who are bringing in capital are going to get 60% of the deal. Just because we're giving the cash its own position, doesn't mean that that person doesn't need to have a job, right? So down here is where we, in these yellow and pink areas, is where we give everybody a job. So we're just saying, because you're bringing in a lot of money, we're going to give you a lot of equity for that. But do not make the mistake of having anybody in this management stake over here be in the 0 column, because then you've got a limited partner. And this is being recorded, and I have to be very careful what I say here, because we want to make sure that our joint ventures are not including any limited partners. I cannot stress that enough. And if they look through your company documents and they see that this is how you figured it out and you've done it incorrectly, you could get a violation. A lot of times if you didn't know you were doing it wrong or you're trying to do your best, they can just give you a fine or a warning. But if you continue to do this and you get caught doing it again, that's when indictments and large fines and even jail time could come into it. So again, do not mess around with this stuff. This partner here put in some money. They don't really want to do a lot of work. So we gave them a job down here where we're going to say, okay, the capital raise here, pay particular attention to it. This is equity given to the people who are raising the capital in the deal. If you are using terms like raising capital or capital raise, it starts looking a lot like you're bringing limited partners into the thing. And so a lot of times I would recommend like not even calling it this. We're just going to call it capital. Who's bringing it in? So for example, up here, let's say Emma's going to bring in $100,000, right? And I'm going to say, well, we needed to raise 538,000 or whatever. So that partner doesn't exist. We're going to put them down to 0. That partner doesn't exist. We're going to put them to 0. So right now, this is the money that Emma, John, and Palma are bringing in is 425 total. We're going to go down here and say, we're all bringing our money in. We're going to get a 12% or maybe 15%. We get to decide how much this is worth. And we get to say, okay, these guys get 0 because they don't exist. We just delete that, right? But see how that no longer adds up to 12? So it has these little checks in here where if it doesn't add up to the right number, then the conditional formatting will light up and show you that you've done it incorrectly. So we've given this 12%. We'll say, okay, well, you know, we don't want it to be that. We don't want it to be like 9%. So we change the 9%. So now it agrees with there, but now the 57 doesn't agree with the 60. So we're like, okay, we're going to change this to 57%, whatever. But then you look down here and you see it doesn't add up to 100. So then because I took 3% away from that, I've got to give the 3% to somewhere else. So maybe we're going to turn this into 28%. And then now this doesn't add up to 25 over here because we changed it. So you just have to keep going through and tweaking these things to say, if we want to say, okay, what did I do wrong there? Why isn't that adding up? Well, this only adds up to 25, but I just said it was 28. So really all I'm going to do is say, okay, well, we're going to give 15% here, and we're going to give 3% of that right there, and now everything adds up again. So it has some nice checks for you to go through to make sure that everything is adding up properly. And it will add up everybody's portion. You can see this formula right here. Emma got her box here. You can just go scroll down and see my box here, my box here. There's probably some if formula that would work a lot better there. If anybody's a spreadsheet guru and wants to clean this up for me, just let me know. But it works like this. It might not be the most elegant solution, but all you're really after is this to give to your attorney. And then this bottom section is really nice because you can go through and you can say, look, Emma owns 40% of this deal. John owns 35, Palma owns 15. And Palma's like, wait a second, I'm putting in the same amount of money that Emma's putting in, and she gets 40 and I only get 15. Well, the reason that Emma's getting a lot more is look how much of the management stake that I have here, and look what Palma's doing. Really almost nothing, right? And so we can come through here and say, well, Palma's like, I don't really want to do anything. I'm kind of retiring and I'm fine with taking 15% of this deal because I'm doing almost nothing. Really, my contribution here is money and a little bit of work. Maybe you're signing on a loan. Maybe you're helping out with, maybe you live closest to the property and go out there every once in a while. It could be anything. But what we decide is down here. Well, let's say Palma looks at this and she's like, 15%? Like, I would really like more than that. And she looks down here and she says, hey, Emma, I noticed that you have a huge percentage of disposition management. But you know what? I'm actually have a lot of experience with that. And so I'd like to come in and get a portion of that and maybe even take 3% and you get 2%. And I'm like, fine, you can handle that. This is where the maturity really starts to show with your partners because you're like, no, I want more. No, I want more. Usually it checks itself because you have the balance of people who don't want to do a whole lot of work and people who want to do a lot of work because maybe they didn't bring any money in. Maybe John's only going to bring in $10,000 because he's the workhorse here, right? And now he owns 6% of the deal, and he's hardly doing any of the work. Emma's still doing most of the work, right? So I'm still getting most of it. I'm going to be like, you know what? I don't really want to do all that work. 54%, that's starting to get into danger zone with voting. So how about, John, I give you some more of these jobs here where we're gonna put you on here for a couple more things that we got to sign you up for, so that things can be a little bit more even. You can see John's up to 7% now because we're taking some jobs away from hypothetical partner and giving them over to real partner here. And it just starts to add up with all these little checks. And this is, again, a great tool to frame the conversation, because, again, you can use it as a psychology check to see if your partners are the kind of people that you want to work with. And going through this exercise really lays out what everybody's job is. And then from this, we can draft up standard operating procedures and job descriptions, especially in an LLC that has more people and will have departments. This will really help you to draft your job description for each person. And the more of this you handle on the front end, the less conflict you're going to have about this stuff on the back end. So we grab this total here, we put everybody's name by it, and I literally just come and paste it right into the partnership considerations. And we'll just paste this table right there with everybody's names and their total percentage. That's all the attorney ever needs to see with what you need for the operating agreement. And then this internal document guides us as a team to say, hey, something came up we weren't expecting. Who's in charge of that? And you go in and you say, hey, you know what, this ended up being a bigger job than we thought. And you can actually adjust this after the fact. And then again, have a meeting minutes where you adjust your operating agreement and your capital accounts accordingly. So there's a lot of flexibility even after you sign the OA. It's a pain in the butt. You don't want to adjust it later. But the opportunity is there in case things happen. Or let's say one person said they were going to do a lot and they ended up having a health problem or a bad divorce, and you need to basically adjust their capital account because they're going to be doing less work. You would adjust it here in the table, and then you could have your meeting for the LLC, put that in the minutes and adjust it. So it's not easy, it's not great to do, but it is very possible. So that is how we go through creating a joint venture.
Question.
Mm-hmm.
Is this just strictly like a joint venture, or does this also work if you're syndicating and you have limited partners?
We do use this table. That's a great question. We do use this table to figure out general partnerships in a syndication, and that's what this, and you probably saw this and we're wondering, because asset management fee and acquisition fee, we're not going to really pay those in a joint venture, because let's say I'm putting in $100,000 and Palma's putting in $100,000 and John's getting 1% of the acquisition fee or something. Basically, Emma and Palma are giving John money at the beginning. Or let's say I'm putting in a lot of money and I'm getting an acquisition fee and just paying myself. So in joint ventures, these fees start to be kind of stupid mathematically, but they also raise red flags with the SEC investigators, because why are you doing an asset management fee or an acquisition fee as managers when you don't have any limited partners? If you have limited partners, then these fees start to come into play. So usually on a joint venture, we'll leave these at 0. But if we are using this same table to decide the general partnership in a syndication that does have limited partners, we will use this. And let's say some of the general partners are going to put in money for general partner equity, because some lenders require a certain percentage of it to come from the general partners. We can just use this for the GP equity. It wouldn't even include what the LPs are putting in. This is just a worksheet for the managers of that syndication. And that's why I added these 2 columns here. Even though in a joint venture, I'll typically just make that 0. And this will be 0, and nobody's getting that. And there's no math associated with this little module here, other than just to add it all up at the end. And the reason is because we're just taking that management fee and that acquisition fee that's over in our master underwriting for the entire deal, and just deciding we're going to get $100,000 acquisition fee. How are we splitting that up? We discussed that beforehand, so we know, are we splitting it evenly, disproportionately? It doesn't affect anybody's total stake. It doesn't affect the math over here on this combined total. It just lets people know what they can expect when the deal closes and as they're managing the asset. But like I said, in a joint venture, leave that zero. So John, thank you for bringing that up because I forgot to mention that. All right, any other questions on joint ventures before we move on to how we're going to use these joint ventures in our investment club? All right, so now that we've gone through how all of this works, I want to share one more document with you. It's called the Official Minutes to Establish a Series. This is something that my attorney gave me for my Series LLC that I run out of the state of Utah. There are 8 states and 2 territories that use the Series LLC in the United States. I like the Series LLC because I can establish a new series for free, just off of my original LLC. And so basically what you're getting here is a free LLC. It doesn't have to be registered with the state. It doesn't have any registration costs. You don't have to file a tax return on it. It's almost like this little invisible LLC. And so I can peel this off of the series of my Utah LLC, and I can go buy properties in Texas or Oklahoma or Missouri or any of the 8 states that honor this, and I can go into it with a joint venture very, very easily. It takes me 10 minutes to fill this out. I would just put our names in here, what our splits are, and then section 7 here is what we would adjust to be our new operating agreement. So I would remove this super, super general statement, and I would put in the things from our partnership considerations and just basically write a very simple operating agreement. We could also have an attorney write this section for us if we want it to be a little bit more professional. So the reason that that's important is because I have been spending a lot of time in my business the last couple of months, like figuring out what stresses me out the most and asking myself that master question. If I could pluck out one thing from my life that's stressing me out the most, what would it be? And sometimes it's something in your personal life, like maybe you have some serious health problems, or your spouse does, or going through relationship issues, or one of your children is having a tough time, or your dog has cancer. I mean, who knows what it is? There's always something that's stressing you out the most. But for me, I had to ask myself that question every once in a while. And I've been really, really stressed out on my business, raising capital. And I got myself into a situation where I was sponsoring a deal and I was raising capital from limited partners. It was a huge amount, the most I'd ever raised. And I realized I don't have a network for limited partners. I don't know a lot of people who are like, just take my money, put it in your deal and you handle it. I just want to be a great doctor, engineer, bridge designer. Most of the people in my network, the people I'm attracting to my meetup, the people I'm attracting and meeting at conferences or RIAs, people who are listening to podcasts that I've been on are entrepreneurs who want to be active members of the deal. And so raising limited partners for that particular deal was just a big mistake. It was extremely stressful. I ended up not being able to do it, let the deal go, and we all lost money on that because we had hard earnest money and we had due diligence costs of travel and paying for inspections and things like that. And we basically all agreed to split that. And my partners who brought in earnest money to that, you know, people who had invested with me and trusted me, lost money right along with me. And that's a terrible place to be as a deal sponsor. But the good thing that came out of that was my opportunity to really reflect on my business model, what I'm doing, what I'm capable of doing, what I'm not capable of doing. I bite off projects all the time that are way too big for me. And this one came back and burned me. And I had to stop and think about, like, why did it burn me? It wasn't the project that burned me. The project was fairly easy from an acquisitions and management standpoint. It's really very similar to projects I'm already doing. I knew a lot about this property because we've been looking at it, buying it for several months. And I had a friend of mine actually was the owner. And so I'd known a lot about this. And I thought, it's not operational. I'm not struggling with that. What I'm struggling with is raising this limited partner money. And I have millions of dollars inside of my network that I can't use because I'd be like, hey, you want to put some money? Like, no, but I'll joint venture with you. No, I want to be a general partner, but no, I'm really not interested in being a limited partner. But when you have an opportunity for a joint venture, let me know. And I was hearing this over and over again. Or people just contact me out of the blue and say, hey, I'd love to invest with you. I have $100,000. I have $150,000. And I'm like, what am I supposed to do with that? Because you don't want to be a limited partner. And it's not really enough to make a dent in a joint partnership. You need like $250 or $500. And so I'm tripping over all of these people who have $50,000, $100,000, $150,000 looking for an opportunity to do a deal. And instead, I'm spending my time over here trying to get limited partners and then attract super high net worth partners and ignoring who's already in my network. And if you're relating to this, and I think most of you do relate to this, because a lot of you are in the same situation where you are hanging out with a lot of entrepreneurs, and you're probably tripping over people with $100,000 or $50,000 or $200,000 they want to invest. They don't know how. They're trying to get into large multifamily. They've maybe spent $20,000, $30,000 on a guru or an education course, and 2 years later they still haven't found a deal because they got to find a deal, they got to vet the deal, they got to raise all the limited partner money, create all the marketing materials. There's just a ton of work that goes into these things. Very steep learning curve. And they can't even find a great deal. And then when they do find one, like what happened to us on that deal we lost, we didn't have the network to take it down with all the limited partners that we needed to raise money from. There's a lot of work that needs to go into prepping to take down one of these large deals. And most of that work is finding the money. So how am I going to take advantage of the opportunities that are right in front of me? And how am I going to help you take advantage of opportunities when all I'm hearing over and over again is I have $100,000, I want to do a joint venture. So I called my attorney, my securities attorney, because to a securities attorney, every deal looks like a security, right? They're going to tell you everything's a security. So I knew that if I had conversations with my securities attorney and he could basically vet this idea that it's not a security, this is for joint venture partners, these people who do not want to be limited partners. So anything that I structure that is a security is going to turn off the people who are most interested in it and being active joint venture partners. So he said, you're doing an investment club, like it's an investment club model. So he sent me home to go do some research on the investment club model. And the standard way of doing that is having an LLC where everybody is going to maybe put in a certain amount per month and everybody's in an LLC. And then you vote or make decisions on what to go invest in as a group. And to bring in a new member, or when a member leaves, you have to change the operating agreement. And you're usually investing in things like meeting the minimums for like an angel investor in a tech startup, or you may be investing in something where you don't even need a minimum. You're just all going to choose stocks together because you just need a team of people to bounce ideas off of. So this is the typical form of an investment club. It's not regulated by the SEC as long as it doesn't have more than 100 members in it, in the members of the LLC itself. So I sat there and chewed on this for a while, and I thought, how can I bring the types of investments to that my network is asking for? And the model is basically to start an investment club where we get together and we just start looking at deals. And if you have no money and you just want to learn, you come to the club, you learn how to vet deals, you're looking at actual deals, you're going to learn a ton about underwriting, you're going to network, you're going to learn who has money, who doesn't have money. It's a great way to build it if you're trying to go out and sponsor your own deals. And it's free. You're going to learn as much, in this free club as you will from a guru that you could spend a lot of money on that education. But really when it gets down to it is the collective bargaining power that you get to have put preferred equity into a deal. And preferred equity is where you go into the deal, you have enough money behind you where you get to start asking for your own terms. You get to go and negotiate better terms. So you're not just looking at the limited partner returns where those are just standard. You put your 50 in or you put your 100 grand in and that's what you get. And you have no decision, no say, and you're not a general partner. You're not getting that on your resume, or you're not getting that experience. But if we have, say, 5 people with 100 grand or 10 people with 100 grand and maybe 5 people with 25 grand each, we can hit about a $500,000 minimum as a pool. We can go in and just start a mini LLC pulling off either one of those series if we're investing in a state that has a series, or just doing a regular LLC if it's in a state that doesn't honor that, like Ohio or California. If you want to invest there, you just have to do a regular LLC. That's fine. We all know how to do that. It's just a little bit more expensive, but it can be done. But instead, you say, okay, well, we've got 5 guys with 100 grand and 5 guys with 50 or 25 grand. We're coming into your deal with 600, maybe 750, 500 minimum, and we want general partnership. You go in there and you just ask, like, how much do I have to put in here in order to get general partnership? And I've interviewed operator after operator after operator as I've been researching this, and 500 grand seems to be the magic number. And usually they're saying you can get, depending on the size of the deal, somewhere between 5 and maybe up to 10% of general managing partner shares, which is usually translating to maybe 1% of the deal, of the total deal. And what that does is it takes your limited partner returns and it bumps them up a little bit, because now you're getting general partner returns. It's not a whole lot, but you get to split that, and it's going to just boost your returns just a little bit. The other thing you're going to be getting is access to the deal, transparency to the financials, sitting in on the asset management meetings, and we may even ask to have tasks delegated to us according to our abilities or things we want to learn, so that we can get that experience on our resume and on our bios. It gives us more credibility with lenders. It gives us more credibility when we go out to raise money someday for our own deals. Or in my case, I probably don't really ever want to sponsor a deal again as a lead sponsor unless I have the money raised before I go into it. It's too stressful. I don't have the stomach for it. So it gives us the opportunity to get into deals that we might not otherwise be able to get into. And also just to test the stomach test. Do I like this? Do I actually want to go out and sponsor deals? Do I have a good limited partner structure? You're watching all the decisions that the team is going, and we're sitting there participating in it, but we're not sharing in a lot of the stress of that. We're just learning. And so I just want to put out there, like, this as a capital raising effort. Do I really want to start a fund and bringing in limited partners and basically go out and completely redo my network? Or do I want to stick with the people that I already have relationships with, that I already am hanging out with, that we're already learning together, talking about doing deals together, and just pool our money up and go do a deal together? Because rather than me having a deal and saying, and emailing each one of you individually and saying, hey, you want to put limited partner money into this deal? Like, I don't like this deal. Emma, I love you, but I really don't like your deal. That's really stressful for me, because I don't know if I can even raise limited partner money. Instead, it's like, we're going to do the pre-raise. We're going to lump together 500 or so, and then we're going to go shopping. We can go out and we can pick from any deal that any operator has going. It's basically a fund to fund model, where we're going to take money in our fund and we're going to put it in their fund and negotiate better terms for ourselves. And if we can lump up to $1 million, you start bringing in 7 figures. Not only can you ask for a little bit of general partnership, but you can even ask for maybe like some sort of a side letter or Class C share, like a different class of shares. It's like, I don't want to pay an acquisition fee. I don't want to pay your asset management fee. And I want an 8 pref instead of a 7 pref. And if the person says no, they might counter you and say, okay, you can have an 8 pref, but you still have to pay the acquisition fee. And we get to decide as a group if those terms are acceptable to us. Because when you are collectively moving into a deal, now you're more like a family office, where you have more power to determine your own terms. And so for me, instead of taking my 50 grand and my goal of being a passive investor, going as a limited partner, I can now pool up with my friends who are all interested in the same stuff that I'm interested in, and make my 50 grand go a whole lot farther. Or occasionally, if you put together the deal, the group, you might even be able to go in without any money of your own, because you're leading it. You found the operators, you took your group shopping, you're bringing in your group, and you might be able to once or twice a year pool up enough money to go into a deal for no money. So it gives you great access when you do have money, but you still have options to get into deals when you don't have any money. And we could do all sorts of things. We could say a smaller group with maybe 200,000, we could put up earnest money. It's a lot riskier, right? But we're going to get a bigger chunk of equity if we bring that in. And repeat that a couple of times, 5 or 6 times before you lose the money, right, when they don't close. But who cares? Because you did it 5 times and you lost it on the 6th, and you start over. It's not that much money when you're pooling it together. We could also take a group of us who want to go sign on a loan, and we're going to get a much bigger chunk. if you're good at raising limited partner money, you could go in with your money, negotiate your shares, bring in some LP money, and negotiate even more general partnerships. So it's very, very flexible in the sense that it doesn't matter if we're wanting to be passive, active, if we're good capital raisers, bad capital raisers. If we want to go off and sponsor a deal, it gives us good experience. And if we get to where we're like, I don't really like this, I just want to be a limited partner, you can always direct invest in the deals yourself and outside of the group and still have great deal flow and everybody analyzing these deals together as a group, learning how to run numbers, learning how to vet operator teams, all those things that make you nervous as a limited partner and make you nervous, like, I don't know if I should go into this deal. You have a nice group of people around you doing the same thing. And then you're able to make decisions with more confidence because you have a group of people doing it. And then the other nice thing about it is that you will really know if you're built for this stuff. It gives you just a good opportunity to get your feet wet in there. John, I see you have your hand up for a question.
Yeah, kind of two questions. So earlier you're talking about how if you have too many people in your general partnership, it starts to look like you're just having limited partners in the deal or in the general partnership. And everyone in the general partnership needs to have roles.
Mm-hmm.
But now you're talking about, we can pool money together, get in the general partnership, and kind of have like passive roles. Just how does that work while being legally compliant?
And this was what took up a lot of the conversation with my attorney. First of all, how do you not have limited partners in your joint venture? And in an investment club, the way it works is everybody's making the decision about where to invest the money and nobody's doing it on your behalf. And this is one reason I invited Sam to come to the meeting, because Sam is a registered investment advisor and he actually can give advice and get paid for it and be legally compliant. I cannot give advice, I'm not registered. But let's say we're getting into a deal, we're going shopping, and we've started with a dozen deals and we've narrowed it down to say 3. And we want an outside opinion. And once Sam gets to the point where you feel like you've done enough of these, you can even start coming in and advising the group, and that's just the cost of the group to pay Sam a fee to advise us. We could also hire an underwriter, someone like John, or I have people who underwrite for large funds who eat this stuff up all day long, could come in and we just pay a fee for them to just do our underwriting. And it may be just the last 2 or 3 deals that it's down to. And so that's how you're participating in the joint venture club, so that there are no limited partners. And then more to John's question is, once you get into the general partnership of the larger group, what job are you going to be doing there? Because then you're just like a general partner in name only, and it starts looking like a violation. The key is to have an actual job. You have a vote. Your operating agreement that goes into the larger fund has a role. So for example, we were talking about this earlier with Sean and Rachel and Brian about doing financial oversight. So we've got an asset management team running the deal, and we're coming in wondering, what's our role here? And on that particular team, we just felt like there was a need for financial audits, and we'll be in charge of financial audits, and it'll be spelled out that that's our job, our role in that company. And it's not exactly hands-on or decision-making, but once a month or so, we're going to go through the numbers and audit it. So just make sure you have an actual job, and you're negotiating those tasks on the front end while you're also negotiating the terms. You have to negotiate your access, full transparency, and what your team is actually going to be doing. And it's based on the skill of the team that we bring in and how it complements the skills of the existing asset management team. So it's a good question, because you can go in as a limited partner. The investment club can buy a security, we just can't offer securities. So we could just go as a limited partner if we don't really feel like there's a role there, and nobody really wants to do anything. I would just rather just watch, right? And that may occasionally happen, but for the most part, it seems like the people I'm running around with want at least a little bit of general partnership, a job, exposure, experience, and then the ability to raise capital, audit financials. If you're close, you can go look at the property, or just doing little day-to-day tasks like being an assistant, like an executive assistant. There are plenty of things that can be done that can legitimize our role in the group as a preferred equity partner. Family offices do it all the time. They have their own rules to follow. We're not subject to the same rules, but those types of things. Oversight, I would say, is the most common. Sam, did I see that you had a question or wanted to make a comment? Not sure if I missed it.
No, I think I'm good. I'm just excited to, I think, get in and learn this stuff. And yeah, I'm no comment though.
Okay. I have a ton of questions because as I've been chewing on this and thinking about it, I just wanted to open it up to the round table. If this is something that is interesting, how do I want to structure this? Because Melanie, you and I sat down and had lunch the other day, and you asked me a lot of really good questions about some of the details that I hadn't even considered. So I don't know if you wanted to reiterate those here, some details that we need to talk about, and also just discussing like, how do we want this to work? Do we want to meet on a regular basis? We need to keep some sort of database on who has capital available when, and so we can kind of get a gauge of timeline. Like, okay, it looks like we'll have about $500,000 or $700,000 about this time, so we should start shopping at this time for a deal to close at this time. So I'm just going to keep a spreadsheet and keep track of who has what available. And if you decide to go buy a house, you just say, hey, just FYI, that capital is no longer available because I did something else with it. Or we form up a group of 700 grand maybe, and you're like, I don't like these people. Like, I don't want to invest in this deal. So then you just be like, I'll catch you on the next one, right? Or if we're voting on a deal and we get to the point and the deal that everybody votes on, you're like, I don't like that deal. Like, I can't invest in this, and you walk. Like, there's no requirement to participate because then, you know, it would be a security because we're telling you how to place your money. It has to be all joint. It's very flexible. And then not until everybody agrees, this is the deal, this is exactly how much, that's when we form the LLC. And then Melanie, you had a lot of great thoughts about after the fact, like managing it after the fact with taxes and reporting. So would love to hear your thoughts there.
I have some other thoughts I want to share too. And I'm not, sure specifically because I'm more educated on the SPV, which is a security. So what you're doing is very similar, acts like a family office, looks like an institution, looks like a fund. So, I mean, I'm using a company called Veravest who handles all of that. They actually handle the distributions, they handle the auditing, they do all of that on your behalf because they're professionals that do it, and there's a cost to that. So if your team doesn't want to do it, you could go with them. But this is a fear of mine, and if you're a capital raiser or Emma, I'm sure you can experience this. There are a lot of individual minds here, and at any second, someone could change their mind and pull out. So it's bad enough when it's a fund that's like, okay, last minute, we're going to the closing table, time to wire funds, send your million. No million, I can't make up for that very fast. Or, so if you guys are sending 500,000 or 700,000 and just one person is like, I don't want to do it at the last minute because you have that right. To me, taking your capital sounds a little bit risky unless you guys are so streamlined and I can rely on you that when you say you're doing it, you do it. That's my fear right now. Especially if it's a smaller raise and you're a big chunk of the raise, like that could make me lose the deal. And it's my money, it's my hard money that gets lost if you change your mind at the last minute. So that scares me a little bit. So I think as you guys figure out what your systems and processes are, how fast can you turn a deal? Because you can't have a monthly meetup and me have one day a month to present you a deal because I only have the deal for 6 weeks. Okay. I need to go ahead of time. I have a window to raise capital, commit, and get the wire in. So I can't wait till Thursday of in June, week 3 in June, to present you a deal that I have tomorrow because I missed it today. So anyway, these are things you might need to work out. You might need your monthly meetup to see all your faces together. But when there's a deal, you might need to schedule who's interested here. Here's the executive summary. Who's interested, show up at 10 a.m. on whatever day and present it, record it. And you need kind of a timeline to get commitments, get your due diligence done. And if you're going to commit, you've got to commit, because if you start trying to do deals and you get to the closing table and someone pulls out and you don't get deals done, you're going to get a reputation as an investment group
that didn't perform. So I hear you on the regular meeting. The regular meeting might just be, touch base, networking, look at some deals, talk about vetting. Maybe we can pre-vet some teams that next time this team has a deal up, we'd like to invest with them. Pre-vetting teams, but when there's an actual deal, we have to have meetings that are unscheduled, like we're meeting at this time to evaluate this deal. Yeah, Chris, ad hoc meetings are doable when necessary, especially if you guys are having a webinar or something that we need to be on, or that we're going to make sure everybody watches the webinar before the ad hoc meeting. I love that word, Chris. I'm going to start using that. Put that back in my vocabulary. And being able to just be more nimble and get these deals evaluated quickly. We just have to have the commits. And I think it's not everybody in the club that would have to commit. It's only the people who have money ready to go and are serious about shopping. I think the second question, or the second thing that you mentioned about reliability, I think it's just like when you're raising limited capital, you just have to over raise. Like if our minimum that we've agreed to come in is 500,000, well, we're not going to go shopping until we have what, 750, 900, something like that raised. So if people are pulling out at the last minute because they don't like the deal, or they don't like the person, or they get in a car accident and they can't wire it, whatever, could be anything, that we can still perform at least according to our minimum of 500. Because you need to know, are we bringing in 5 or are we bringing in 7? We're like, well, we can commit to 5. We're going to try for 7. And wiring money in well before closing is how I solve a lot of this when I'm in deals and joint ventures, or even in syndication. Like we need those in for closing 2, 3, sometimes 4 weeks in advance. So it's sitting there ready to go. And people can still pull their money back out after it's been wired, but that would be, don't do that.
Emma, I refresh my memory. I don't remember exactly what I was asking about the tax structure and stuff.
You had mentioned something about who's going to audit the K1s. So, or how is the K1 when that's issued at the end of the year? The K1 is the stockholder document that you get issued to you when you've invested in something, and you give it to your tax preparer, and then they use that to show your income or your loss from any investments that you're in. So the entity would be issued a single K1, and then we would have to take that according to our equity stake to the CPA. So I think that's a detail that we would definitely need to see how that's going to affect us, because we can also participate in the depreciation of the asset according to the K1. And so making sure that the K1 is accurate, I think would just be something where we need to hire someone as a group.
A CPA could do that, but honestly, if you are all not professional underwriters, you're not professional auditors, you're not, this is the thing I come across as a capital raiser. Passive investors, for the most part, do not know how to vet a deal. Bless their hearts. That is where I come in with my professional institutional grade underwriter, and where I hire Verivest, who does the auditing on my behalf. You don't trust me to audit finances from an operator. No, I send it to a professional. I have a professional underwriter. Don't trust me. I don't trust me with my underwriting. I hire someone for that. So you guys should do that too. So I introduced Emma yesterday to my underwriter, and he works for Bridge Investments. If anyone's here in Salt Lake City, they're a deca-billion-dollar fund. They're $20 billion. Well, I think they're actually at 30 now. Yeah. But he is the director of their 1031 department. He underwrites deals all day long. He buys 5 to 6 a year, sells and buys for this 1031 fund that's rolling over. And he underwrites all day to their standards, Bridge Investments trained standards. So he's my guy. The auditing piece comes in for me with Verivest, and there's plenty of companies like Verivest. I just like Verivest because I've been dealing with them for a while. They literally take the finances from the operator, they audit it, and they're like, hey, they paid for this twice. Hey, why are they paying so much for this? Oh, they might have a leak. This water bill is way high for what this should be. They audit it. You go back to the operator, say, fix these numbers, explain yourselves. Okay, now I have real numbers for my quarterly reporting. We're good. And then that's, someone's auditing it for you. Unless someone in your group is actually a professional and can do that, I would hire that stuff out. But it's, it costs money.
Well, I think some groups, because basically what we're creating is the larger investment club, and then you're going to have a micro club inside of there. So the micro group is the one actually putting money in and forming the LLC and investing in a deal, one LLC per deal. But we still have the larger club. And so that's why maybe Sam can give expertise according to his expertise. And maybe someone like John or someone like Derek, we could pay for underwriting. Let's say, John, let's say you're not even in a deal. but we want you to do an annual or quarterly audit of the finances, and that's just a cost of the fund. So when you put your 100 grand in or your 50 grand in or whatever, we're going to have to set some aside. We're going to have to over raise for the 500 minimum. We're going to have to set some aside for costs because we may want an attorney to write our little operating agreement. We may want to pay an investment advisor to give us advice. We may want to pay an underwriter, and then we may want to pay an auditor. So there are costs of the fund. And in states where we can't use the series LLC, there are costs to maintain the LLC. So the annual registration costs, the attorney filing, the registered agent, and all of that. And so there are going to be costs of the fund, but that's going to vary depending on who's in that micro group and what state we're in. And so that's just something we have to figure out at the beginning. Like, okay, we're going to raise a 500 minimum. We're going to over raise to 750, and we need to set aside $10,000 for expenses over the next 3 years for this type of stuff or whatever. What was that?
Can I make a suggestion? At least for me and the SPV, I'm going to negotiate with the general partnership to have a due diligence fee or an acquisition fee or whatever. Get part of their acquisition fee that covers your lawyer costs, all your upfront costs. You should go to the closing table and not lose any money. And then set aside whatever your monthly cost is. If you have a CPA or a lawyer, or if you're employing, if you have Verivest. So Verivest costs me $291 a month per million. Okay. So that includes all the CPA stuff, all the auditing. I have my own investor portal, everything that they do on my behalf. So that just comes out first before anybody takes splits. You have a 0.5%. That's just the cost of having a fund or whatever. Yeah. That's it. So that comes out first. Then you talk about splits, and then that little 0.5% or 0.75%, you might grow a little savings account. So when you need to have a lawyer look at something, or you all want to get together and have drinks to celebrate, whatever, you have this little business account that is growing. And then at the end of the day, when it liquids and everyone gets their returns, that is split pro rata to what your investment was or whatever. But you can negotiate that in a side letter to get some of that acquisition fee just for your costs. An SPV cost me $7 to $9 grand. I'm not going to lose money going to the table doing a deal. Someone's going to pay for that, and it's not me. So, yeah.
Well, and for us, the SPV is it's just like an LLC. It's just the special or single purpose vehicle, which is what we discussed with my attorney. It's basically a series SPV. So it's just an LLC. It costs the exact same amount to set up. The reason that yours is more expensive is because you have limited partners inside of it, need the security, the security disclosures drafted by an attorney. That's much more expensive. But we could start a joint venture SPV, which is basically what we're doing, and then we're peeling off series from it in states where they honor that, and in states where they don't. I was looking at also a platform called TribeVest, where in states where we can't use the series, because it's just dangerous to put something in a series, because let's say we're using a series in Ohio or whatever, and we get sued, then they're going to go after every deal that's in that parent LLC because they don't respect the series. And so it just makes more sense in states that don't honor the series to go in with just a separate LLC, and that will have some maintenance costs. But I think TribeVest is like between $5 and $10 a month per investor. So if we have 10 investors there, they take care of the LLC, the filings, the operating agreements, they're the registered agent, and they're able to just maintain a lot of those costs. And we don't really have any upfront. We just have to pay our, say, $100 a month fee for 10 members at $10. And they have tiers you can do. So I thought that would be a really good solution for states where the series is not going to work. And then some of the deals might benefit from something like what Verivest has. They seem, I don't want to use the word overkill, because they really are tailored to people who are bringing in limited partners and have a lot of reporting and things that need to go on. But somebody like that who will provide a lot of our auditing, we just have to find a good resource there, and each group can choose a different solution. That's the nice thing about it. It's extremely flexible and nimble, because each small group of people can be doing it a little bit differently. One LLC per deal, and it could have a different person. It can have a different group of people in each LLC. So that's the nice thing about doing it as a club model, because you're getting to know the larger group. So by the time you're splitting off into a micro group, you've spent some time with people, and you know if you want to do a deal with them or not. So does Verivest have any other tiers of product that we say, okay, we only need these services, or is it just kind of an all or nothing at this point?
So what he calls the SPV in a box, and Lance Peterson is my contact there.
Mhm.
I think there are 180 SPVs with Fairway America. They're a 100 million AUM company. But anyway, that's his background. So I think he'll create whatever you need. And I think it could be a la carte because the SPV in a box is a relatively new product. I'm a beta tester for it.
Okay.
Lamb and Good Egg, they're beta testing it. So I think it's kind of a work in progress. But yeah, I would just talk to Lance, tell him what you need. He could come and talk to this group. He's my buddy. He's in Portland. Easy to talk to, easy to get on calls like this.
Yeah, I think he Facebook friended me yesterday. So I'll have to reach out and see what he has to offer. I think that we still have a lot of options. I think what I'd like to just figure out is like just scheduling a meeting. And we can even replace this monthly meeting with an investment club meeting and stop having a speaker and instead just start looking at deals if that's something we want to do. Or we could have a separate meeting outside of it where we're still doing the educational component, but we're also meeting separately to just look at deals, vet operators, get to know each other, and then having the special meetings when we actually start shopping. There needs to be some amount of speed that happens with that. Alternate a speaker or deal. We might be able to do that like on a bi-weekly, like have 2 meetings a month. So it's the same group, same Thursday, same time, but we're meeting every 2 weeks instead of every month. That could work too. I think if we're doing it every other month, it might not be often enough. I don't know. So unmute, raise your hand, throw your input in, concerns, questions, suggestions. I really would love to get like this roundtable kind of flesh this thing out so that we can get going, because I feel like I got a couple of deals under contract right now, and once I get those closed the end of June, like I'm not doing that again. It's too stressful. So I really am looking forward to shifting over to this model and just having more freedom, flexibility, and control in what we're investing in. A lot less stress to be raising money against the time clock. Like I hate doing that. So what suggestions do you guys have as far as timing and meeting frequency, and when do we start?
I'm going to put Lance's contact, his LinkedIn in there. Please use it wisely. Don't blow him up too much. But anyway, it's in there. So with Veravest.
Maybe he LinkedIn'd me. Let me see. I can't remember. Yeah, he LinkedIn'd me.
Only 34 people that can reach out to him. It can't be that bad.
Yeah, that's true. How many people do we have left? We're down to 34. So
my recommendation is, I don't know what you guys want to do. I'm lazy and I like systems and processes. I would focus on finding your professional underwriter, your professional auditor. I would systematize this, and I just feel like you're going to herd cats because there's probably a lot of levels of experience in this room, and some people probably have zero interest in underwriting. That's me. I'm not an underwriter, but it's very important to have a good underwriter. So unless someone just loves it and wants to take that on for all of you, I would just hire out the auditing. Just get good at creating relationships and finding deals, and you shouldn't have a problem.
We can also offer equity to those professionals. Like, let's say, instead of paying someone a couple $100 to underwrite a deal, they're like, I'll waive the fee if you give me 1% or whatever, because that's going to be more than they would have made underwriting a deal anyway. So we just have a lot of options. And I think each group, because it's small and it's nimble, can choose who they want to be doing our professional services. We're going to have people in the group like Sam or John, but we can have lawyers outside the group, like, hey, I love my CPA, I want to use it. Like, each group can be different, but I think you'll start to see the same people coming up over and over again, because inside of a network, we're going to use each other. But at the same time, I always do really recommend switching it up sometimes to get a fresh perspective, especially when you're dealing with legal and financial and the IRS. It's nice to sometimes have another set of eyes and a different opinion. So to avoid using the same people over and over and over again, where we keep doing the same wrong thing over and over and over again, and next thing you know, we get nailed for the IRS or the SEC or something. That would take something that was designed to be less stress and turn it into a lot more stress. So we just need to be careful there.
I think Derek's listening. He just texted me and he's like, I want equity.
Yeah, Derek's the real deal, man.
Where is he? Where is he? I don't. Oh,
He called in because he's driving.
Ah.
So I texted him earlier and invited him to come in and take a listen because I think like Eloy, you raised your hand on underwriting. You enjoy it. I know I was talking to Earl Klein yesterday, and he's like, I love underwriting. Oh wait, you're raising your hand that you don't like it. Never mind. John was raising his hand that he does like it.
No, that I don't like it.
Oh, you lied.
I thought.
It's the biggest time suck.
Yeah, but what if we just handed you like 3 deals that we already vetted and just do these 3?
The thing is, when you have a professional like Derek who's listening, he can underwrite a deal fully from scratch from T12, rent roll, and OM in 3 to 4 hours, as long as the T12 isn't stupid, because you get some of those on the mom and pops. 3 to 4 hours, he can underwrite it. I mean, he's a pro. It might take me 3 to 4 days to underwrite something like that.
Oh, I just don't even do it. I procrastinate it for 3 to 4 weeks, and then I say, hey, John, can you do this for me? So we've got a hand up right here. Who had their hand up? It went away.
Yeah, sorry, that was me. That was me. But
there you go. Go for it.
Yeah, I was just gonna say, for unless there's somebody like you're saying that has done it hundreds of times, that has been verified and trusted, that they know what they're doing, it'd almost be better just as the group than to have it as an outsourced thing. That way, if something goes wrong, it's not somebody in the group to be blamed and shut it out, say, oh, it's your fault, we failed, and get out of here. It's an outsourced thing, and that way if it goes bad, we fire them and hire somebody else to do it. But
it would be pretty devastating if somebody inside the group did it and screwed it up, because then you're a partner with that person. So I do see your point that sometimes it's nice to just say, hey, we all paid for this dude, we all took his advice, we're all sinking in his ship together. I think that this is one of the reasons I like it is because it's super low risk. We don't put any money in until the deal closes, but we still have all the normal risk of investing in a deal, making sure that we vet it out properly. So I don't want anybody to feel intimidated and be like, because the point of this is when you're hearing all this and you're thinking, oh, I don't know how to invest in this deal, like I have so many things to vet, so many details, is you can split up your money across a diversity of deals. How many times are you going to screw it up in a row? So instead of throwing 200 grand at one deal, you might be able to throw 50 grand at a couple of more deals. And the other nice thing about it is because you're doing it in a group and we're all sitting there, if we're starting with a dozen deals or 14 deals, we're not going to hire an underwriter to do that. We're going to do our own screening. We're going to do our own initial underwriting. If you don't know how to do it, somebody in the group knows how to do it. We're doing it together on a video call. And it's not till we get down to the last 2 or 3 that we're like, okay, these are our final candidates that we might want to pay somebody to do that. Or if somebody in the group's like, we trust them and they feel confident doing it, we can always bring in somebody and pay them in equity or something. So we have just tons and tons of options and flexibility. And it's not even that scary because we're putting together our skills and talents and tapping into each other's networks, because you all, I'm sure you can all think of at least 5 people that either have capital or have some sort of expertise they could offer to the club. And it's one of those things where you're like, I don't want to go to the meeting anymore. So you leave because you didn't pay for it. So who cares? Like, you get to the point when you're ready to put money in, you get real serious and you're coming and you're vetting the deals. But in between, when you don't have any money and you don't want to come, don't come. You start showing up when you're like, okay, I'm selling something, I'm getting some money down the pike, I better start going back so I can start shopping. There's just so many options. Would the focus be multifamily, or is it interest in commercial and mixed use as well? That is a great question. I think that the interest would be according to the small group that's investing. Like, we could probably keep some sort of a spreadsheet that said things you're interested in investing in, like multifamily, industrial. We can even do non-real estate investments just to diversify, to be able to say, look, I got a lot of real estate in my portfolio and I'd like to do a tech company, but they've got a $250,000 minimum at the Angel Club. So you just go and start a little splinter off, like who's interested in tech companies, and you could start your own little group and go look at tech companies. I don't know how to vet those, but it might be something that you could vet. Melanie, go ahead.
Something I'm running into, because I have a mastermind of capital raisers and we pull together to do the SPV. Something I'm running into though is I spend a lot of time sourcing deals, making relationships, bringing deals to the group, and then I present a deal to the group. and then it's crickets.
Yeah.
It's super annoying. So if you guys, you might have some wallflowers in here, and that if people aren't stepping up and actually looking at underwriting and looking at deals as an option, and now people are spending time sourcing deals and sending them out to these great deals, and it's just crickets, they're not going to take you serious or send you deals again. It gets very frustrating for the deal sourcers. So just something to think about.
I think one way to be able to deal with that at the level we're doing it is if you're crickets or your wallflower, maybe you're not cut out to be a general partner. Maybe you're more cut out to be a limited partner. And this is an opportunity for you to play in the sandbox and see what you have the stomach for, what you have the tolerance for. It's like, this is a lot of underwriting. Like, I'm just going to go put it in a blind fund and throw it at Bridge and let them invest it for me. So it really gives you a lot of opportunities to see where you fit in. And I don't want to be vetting deals for the group. Like, I have no intention of doing that. I think that it's one of those things where we vet deals as a team. When we have the cash and we know it's coming in about this time, let's start shopping. And if you're not showing up to the shopping meetings and then you're just going to throw your money at the end because you just trust whatever we told you, maybe you're better off as a limited partner. It just tells you things about yourself. Like your buy-in and your level of interest and your level of activity. You get in and you're a general partner in this thing, but you never go to their asset management meetings. You're not doing any of the delegated stuff. And eventually you're like, you know what? I kind of like being a limited partner. I don't want to do this again. So I think it's a great way to test the waters and see if you even like it. Especially if you think you're going to love this and you're going to go sponsor a deal and you get 2-3 deals in and you're like, oh, actually, I hate this. Wouldn't it be nice to figure that out with a toe dipped in than having jumped in and sponsored a deal and now you're on the hook for the whole thing? So I really do not want to be pre-vetting deals and bringing, okay, here group, now's the deal, you put money in. I'd like to have the money commits first before we start vetting deals. In my opinion, that would be a lot less work and a lot less stressful. But I don't know, weigh in, throw your opinion in what order of operations it should be here.
A soft commit, or are people wiring funds?
Soft, like just keep it on a spreadsheet. Because if we don't have an LLC, we don't have a bank account. So there's nothing to wire funds to. We start taking funds, that's a violation. So we can't be accepting funds in any way, shape, or form unless I have a different legal structure. Like some sort of a segregated fund where I have the master PPM and we start collecting funds and then we allocate it, which that's a different thing altogether.
Yeah, we would avoid that. I'm just wondering, so you're saying you're going to soft commit $750 and then shop in the 500 range. And
then shop for the deal. And then and I think that you're correct in the fact that we have to give the deal sponsor some assurances that we're gonna perform. I don't know what that would look like because at the end of the day, I can't control what other people are going to do. I can't even barely control what I'm going to do. Like maybe I think I have $100,000 coming in and I sell the property and it's 12. I mean, you just don't know, right? So what kind of assurances could, other than just over raising, that's the only thing I can come up with, and a track record. The first time we do it, we're going to have a track record. People are going to be like, and then we might not get as good at terms. So if we can perform repeatedly, then we're going to get better terms eventually. And
that's
if we can't,
pretty real. And Emma, you feel it because you had people that pulled out on you at your deal that your team lost 6 figures, I think, right? I mean, it's serious, and they're only going to let you do it to them once.
Yep. And we'll never be able to make an offer on a deal with any of those sponsors again. We get burned. So it's important if you commit to perform. I think that's one thing that it's one thing if you have an extenuating circumstance, like my husband just got in a car accident and we have major medical bills coming up and things happen. But I had a partner on a deal that he was doing a different deal, and he had I think a $250,000 commit from a single individual, like a high net worth individual, and they were supposed to be wiring money in like on closing day. And that morning, he was at the title company's office. He's sitting at the conference table and he gets a text like, dude, I wish you the best, but I just can't do it. He just lost the stomach to put $250,000 into a deal. at the closing table. And he called them up and he said, this will get around. You leave people high and dry at the closing table like this, it will get around, and you will not be able to invest in these deals anymore because it's a small community. I'm not telling you have to wire the money in. I'm not threatening you. I'm just letting you know what you just did was absolutely against the code. And if you want to get access to these deals, you cannot ever do this again. And the guy was like, I know, I just jumped in too soon. And he ended up scrambling and making calls at the last minute and got the deal funded. But very, very stressful. So don't be that guy. You commit, unless it's extenuating, you need to follow through. I think that that's just really important for everybody to understand before they commit. And we'll overraise to account for flaky people or extenuating circumstances. But at the end of the day, you got to know people are depending on you. There's a lot of hard money on the line, even if it's not yours. So it's getting late. East Coasters are up way past your bedtime. Okay, so I think probably the best thing to do at this point is I will put something out on the Facebook group. I have a LinkedIn group too, but there are like 4 people in it. So I'll put it out on both, but let's keep talking on the Facebook group. Summer's coming. I know people are really busy over the summer. My meetups tend to just, attendance goes way down in the summer. So I don't know when the best time would be to start building the database, and we could do that immediately. Just putting it in like, hey, I'm super interested. I would love to be able to negotiate better terms with preferred equity. I have this much money coming in, and we could just put together. I'm thinking like a Google form that you just fill out, and then it automatically fills out the spreadsheet. And then if something changes and you don't have the cash that you thought you were going to have, you would just put in the notification like, hey, actually, I'm out, as soon as you know. And then we just look at the spreadsheet. And when I see that there's a certain amount of capital committed in a certain time frame, I'll just start reaching out individually and schedule a meeting with everybody and see where everybody is.
As someone who would potentially have deals, and I have a couple on deck, I mean, I know you're saying you want to get the soft commits first, but maybe people aren't ready to soft commit because they haven't seen a deal. They don't know what the return projections are, the commitment timeline. Like, I'm wondering if you should do some sample, like maybe not sample, but real, like, hey, this is a live deal. This is what it could look like. Is this something you'd be interested in? Because, I mean, I know I have an opportunity right now that's random, but it's good returns. It's a 13 cap of a portfolio of single family homes. So all on the same street. I mean, so I don't know. I mean, do your thing, but I'm just saying, like, there's opportunities, and when you go shopping, that's not always when you find the deals. Well, and I know when I was talking to Ben yesterday, that was one of the things he mentioned. He's like, I don't know what a good deal looks like. Like, it sounds like, great, but what does a good deal even look like? And I think being able to start to recognize that I think that's what the club meetings are for, is to look at deals, start looking at live deals and be like, well, nobody has any money to invest in this and we're not good enough to invest in this yet, but let's just start running live deals. I don't know if we want operators to come and pitch us. That might be something you can think about as well. So, in an angel meeting, when you go and you sit down and the tech company entrepreneur will come and pitch you, and he gets 20 minutes for his slideshow, and then the next guy comes and he gets 20 minutes. And then at the end you mingle and you meet each other and you follow up. Is it something that you think that would be useful to have operators actually come into the meeting and do a pitch? Or should we just be looking at deals without the pitches, or a mixture of both? I don't know if you have strong feelings either way. You're not asking. You're asking everyone?
Yeah, just everyone. Like, do we want operators to come in and pitch us?
Yeah, I say both.
Never. Both?
Yeah, that's my thing.
Who is good at vetting operators? Because you vet the deal numbers, you vet the team, and then you vet the town. I would love to have some expertise on vetting operators and just doing like background checks and interviews, things like that, to just kind of see who we're dealing with. And we could pre-vet teams to come in, and then when they bring us a deal, we don't have to vet the team because we already did. We could have maybe a dozen teams that we're looking at or something like that. And each of those teams that we pre-vetted could come and pitch us. And then if we're shopping, you can throw it into like, hey, I got this from somebody, you can throw it in. We would just have to start from scratch. So how about this? What if I can get a couple of operators to come and introduce themselves to us, and we can even meet once a week at the beginning to get our core team of people? Would weekly be too frequent? Maybe not forever, but just meet weekly, just to get our group, our core group together, and then we could cut back from that point and come to us and show us deals.
I can weigh in on how I've done it, because it is true. Like, you have with this group, you had but 35 plus people.
Mm-hmm.
Like, your core group is probably 10 or less of you. Like, really, there's probably a bunch of wallflowers, and then there's a bunch of people who are just going to get it done. This is why I said earlier, like, the whole vetting operators and things, it would be nice to pre-vet everyone, run them through their background security checks, have coffee with them, meet their children, whatever, so you know where your leverage is later. That's not always realistic, because the deal comes, so you're scrambling to do everything that you want to do with your vetting, the market, the deal, the operator, and I always separate the structure out of that, because how the deal is structured is huge for me. But I will, there's companies like Verivest, they've verified a bunch of operators. I maybe tried this, but yeah, they run
background checks and securities violations and all that. And then, well, here's the thing: if we want to interview a couple of core groups of people, then we know how. So it's when you have to have speed is when you have to have done it a couple of times. And so if we could just vet some on open time, it would be a lot easier to do once we get to the point where it's like, hey, somebody just brought a new operator in. This deal looks hot. Like, we want to invest in this. We better move fast and get this vetted out. But if we've never done it before, it's going to take us forever. So maybe we should just start out vetting a few deals and vetting a few teams and start feeling comfortable with our processes, and just start meeting pretty soon to do that. And then once people are feeling a little bit more comfortable, and the soft commit would be nothing more than that. You're just putting when you have money available. And then once you figure out what a good deal looks like, once we start shopping, you'll figure it out real fast. Because they're like, 6 metrics that most people tend to be able to hold in their head. And then the operator sponsor. The problem is a lot of us have different goals. So if some of us are investing for cash flow and others are investing for high returns and cash flow later down the road. And so finding a deal that meets our individual needs, even if it's a good deal, might not be a good deal for everybody on the team. And so I think that's why it's important to get a sense of what's important to you, and finding a core group of people who are going to invest in those types of assets, like new development or heavy value adds or storage or whatever. Alan, let's have you go next.
Sure. This is probably going to complicate things more, but I have a group of investors in Atlanta, different skill sets, but really they're just going to, trust me that I've vetted a deal. I'm working with this investment group. Is there a situation where I form a investment club that's a member of this bigger investment club, and almost I'm like the mouthpiece to this smaller subset, and I'm actually throwing that out there to try to make things easier and smoother and reduce communication, but I don't know if that's going to actually make things more difficult or not, or do I just start bringing in this wave of people to these sort of meetings? I don't know where I would sit on that line, kind of thing.
I think that it's one of those things, if you want to have a micro group that's going to go invest in something, make one. Okay. You know what I mean? Like it's an idea that I have, and maybe I'll be the one spearheading, like making sure we meet and putting up operators in front of us. But it's not like I have a patent on. I mean, I know. Last night somebody's like, "Oh, I know a lady on the East Coast who's doing the same thing. Let me introduce you to her." So it's like, if you want to go start one, it's an LLC. It's not that hard. And once you've done it 2 or 3 times, and maybe I'll do a couple of them, and you won't even participate because maybe you don't have any cash or something, but you're watching us do it, and then you get a group and you go in and you sponsor your own group. And that's a way you can get into a deal without any of your own money. If you bring the group together, sponsor a deal, they're in the larger group, but you're just doing a little micro, and other people in the group might want to come in And some of your people might come in and join somebody else's deal. So I don't think that it's like Emma's going to sponsor all these deals, put these deals in front of everybody, and I'm going to be a partner in all of these things. That's not my intention at all. My selfish intention is to have great deal flow, and when I do have money, to put my money on steroids by being able to go in and negotiate preferred equity for my own money with yours. The other selfish reason is a couple of times a year, hopefully, I'll be able to get into a deal with no money because I'm guiding the process. But there will be other deals going on that I have no part of because I either don't have any money or I don't have any value to add that other people are doing. I think that's really where the beauty of something like this comes, because we're building a network, and you all know how to do it because we just did it. So I think that if you're bringing people in, there's no poaching. I mean, but if these are like partners that you don't want to get poached into another deal, you just take the model and have private meetings.
Oh no, it's not a poaching concern. It's do we double the size of this kind of concern, and then
I think so.
And then will that be better, or is that going to slow everything down, or should I say, hey guys, I'm working with Emma's group. Let's form our investment club, and we're going to invest in Emma's investment club, and go from there. Yeah.
And it's possible. You could have layer upon layer of LLCs deep. I don't know if it complicates it or not, but I think more people in the group is great. It's just the core people who have cash are the ones who are going to be vetting the deals, and the people who aren't in for that round are just going to be observing.
Right.
Really. So, and it keeps the core group as the ones who are doing the interaction and getting the work done. And you're on the outside, you're observing, you can come, not come, whatever. And then when you do have cash coming, you start attending more often and start shopping. So it's when we form the micro group that I think that it starts getting serious. And some of us will have poaching concerns, especially if they might turn into a limited partner eventually. You just need to be aware of that. I would say I'm not going to make anybody sign an agreement or non-disclosed, non-compete or any of that ridiculousness. If you don't want your person to get poached, don't invite them. Like, it's just as simple as that.
Yeah, I think a lot of my investors don't want to come to meetings. They don't want. They almost just want to be passive, really.
Yeah, and that's how you get them into your pool, your limited pool. You know,
right.
Because if they don't want to come to the meeting and they don't want to be operators, then you're probably the wrong fit, and you're just going to have a blind pool or some sort of a segregated fund. But for the people who are like, no, I want to be a manager, I want to be hands-on, I want to get my feet wet, those are the kind of people I think would be really suitable for this club. And if they get their feet wet and they decide they don't like it, then we just shift them over to a limited partner blind pool. Yeah, so I think that the more people, the better, because if we're trying to raise, let's say we're going to raise $1 million 3 times a year, that takes a lot of people. It takes a lot of people. You know, it's $100,000 from like 30 people who are actually going to perform. That's a lot. So the more people we have, and the more people are coming in the club, the more deals we're going to be able to do, the better terms we're going to be able to negotiate. So the bigger it is, the better. But we're only going to have 5 to 10 people in each micro group when you think about it. Dawn, you have your hand up. Sorry.
No problem. Yeah, I had a similar question to what Alan was asking, because kind of same thing. I've got a lot of people around me that with cash, but again, wouldn't have time or interest to want to come to these meetings and find out. So I could either form our own local group to invest in that group, or just, I guess, represent them on behalf of the group and have them still put their money in individually, but I'll just be like their in between to tell them what's going on and have them say, here's the group to invest your money in. So it's not just trusting in me directly, but in the group. So that was one thing. You kind of somewhat addressed that with Alan anyway, but I guess the second question was going to be, is if the plan is to keep this group essentially just virtual only, or you plan to do some physical group and virtual, if you want to have a Salt Lake and say Idle Falls chapter or something, and then virtually as well.
Let's do virtual and see how it goes, and then. I mean, because when I first got here and I first started investing, I started attending the Angel Club, Salt Lake Angel Club, and I think there's one in Park City as well. And I said, I want to present real estate deals and they're like, no, they hate real estate deals. Like when we send out surveys, they want to see more tech and less real estate. I'm like, great. I said, maybe I should start my own angel group where people show up and all we're going to look at is real estate. It's a real estate angel group. And he goes, you know, it's a lot of work to run an angel group, right? I'm like, it is? And he's like, yeah, you got to get people, butts and seats. You got to find a place to meet. You have to have enough operators to come and pitch you every meeting. It's tough finding it. It's tough doing it. And I was like, well, what's your motivation? He's like, I don't really have any motivation. It's just to get, when I have money, to be getting better access to more deals as an investor. And I was like, oh, well, maybe I don't want to start an angel group. So this is an idea that's like 3 years old from that perspective. I think that running an angel group virtually is going to be a lot easier. I don't have to find a meeting space.
Right.
I can only get 2 butts in the seat. Who cares? You know, you walk into a live meeting and there are 2 people there. It makes you feel like a failure. And it's kind of do on online too, but it's not as bad. So I would love to do virtual, but eventually it might be nice to start doing it live if we can find a space and telecasting it for the people who don't live locally. I think chapters is like, that's like starting to look like a RIA. And it's like when people get a business idea and they start talking about how they're going to franchise it and then they're going to license it and we're going to partner. You're like, oh, okay, slow your roll. How about you just do a minimum viable product and show me how it goes? So I think that's kind of the point that I'm at right now. Let's do a virtual. Let's see who shows up. Let's see how fast we can pull up 500 grand or 750 or something like that. And then depending on the direction that it goes, if we only do 1 of these a year, whatever, it's 1 more than we would have done if we hadn't done it. But I think I would like to see 2 to 3 a year of at least 500,000. That's kind of the goal. And if we're not doing that, it might not be worth their time to do. But regardless, I think everybody attending is going to learn a ton. I think you're going to learn more from this exercise than if you're in a classroom with a $30,000 guru that you paid. You know, look at live deals, and the only money you ever put in is an actual investment in a real deal, rather than 2 years later wondering why you still haven't done a deal. It's just to me, it just checks so many of the boxes of problems that my network is facing and problems that I'm facing in my own business of things that are stressing me out that I need to cut out. And so for me, it's just such a solution that's so encompassing of the things that I want and cutting out all of the things that are not good for us.
Yeah. And additionally, I guess a couple of other points, I guess. So on that spreadsheet you're saying with people's names and what their soft commit is, I don't know if you'd want to have a separate column there for what investment types, like say if they only want multifamily, or if they want only commercial or anything, or whatever. And then, and I guess another question I had just in general, is this the point of this club, fund, whatever, to essentially only invest in syndications, of other operators, or is it to at some point purchase our own deals and have like our own property held by the LLC?
If we can bring in enough general partner equity, most lenders will want 5 to 10% of the equity to be coming from the general partners. But if you can start bringing in 10 to 20% of the equity from the general partners, raising enough money for a large deal could be up to $2 million, but usually $500,000 to $1 million will satisfy that requirement on deal sizes we're doing 5 to maybe 15 million. Then family offices will start looking at you. And so we could go out and sponsor a deal and put in 500 or 750 or $1 million of general partner equity. And when the family office comes in and looks at it, they're like, do you have 20% or 15% of the equity from your GP? And we're like, why, yes, we do. And then we show it to 200 family offices and they come and bring the rest of the LP. So that's definitely a possibility. I don't think that's something I'm personally interested in because I hate asset management. I'm trying to retire and I'm trying to go remote so I can be more nomadic. And so for me, it's one of those things that you can dial into my network of family offices. Do I want to sponsor a deal like that? I don't know, maybe not. But is it possible? Certainly. We can bring in that GP equity. We can certainly attract the attention of preferred equity placement firms. If you give them the debt, they'll bring in the equity, but they make you bring in a certain portion of it. You can attract the attention of institutional capital where you just pay them a 3% fee for bringing the rest of the equity and you just take that out of your acquisition fee. You can attract the attention of family offices. Like GP skin in the game opens a lot more doors than if you have no money, you're scrambling around for earnest money and then you're trying to raise it all from LP on your own, which if you're great at raising LP, that's always going to be your cheapest option. But if you're not that great at raising it, you can put together a good, strong GP team with cash. You just have a lot more options. So yes, I do think that that's definitely a possibility. Are some people in the group going to do that? I think for sure. Definitely, I see that happening. If you do this and you get into a couple deals and you're like on fire and you love this, go out. It's like the opposite of the guy who wants to be an LP. He's like, I really like this. I'm going to be an LP. We will have some people in the group who are like, this rocks. Like, I'm going to go do more of these, and you'll go sponsor, and then you'll bring the deals back to us to see if we want to invest. I can see it definitely, people being in all three buckets at any given time. All right. Any last questions before we wrap? We're losing people like flies. It's getting late. All right. I think after listening to everybody, I'm kind of thinking like I'm going to follow up in the Facebook group. Let's plan a meeting. I don't know for what day. Maybe I'll throw a survey out there for the kickoff meeting. We might start meeting, like trying to meet this time every Thursday, like 6:30 Mountain every Thursday for the next month or two, so we can start vetting sponsors, teams, and start looking at real deals. And then we can start taking soft commits. If we do that every week for the next, say, 2 months before the summer really kicks in, we might get some traction before everybody falls off the map. Does that sound reasonable based on what we discussed? Okay, I'll get it on the calendar. I'll get it in the group, and we'll just plan to meet again next Thursday. Melanie, are you free to maybe come in? You want to be the first operator pitch? Oh, we lost your volume. I think you're muted.
Yeah, we're muted. Thursday. Yeah, we're on meeting. Just League's meetup. Brandon Turner's the speaker that night, but yeah, she'll be done at 5. So yeah, 6 is good.
Done at 5. Okay. And I have a couple of other operators that I can invite and get queued up, but I know a lot of them. I don't know if they're any good or not. So if you have some operators that you like that maybe you've already vetted, or like Eloy, you're a perfect example. Like, you sponsor deals. If you've got something you want to come and do an operator pitch, if you are a sponsor, let us know. Or if you've invested with somebody as a limited partner, that would be a great person to have come in and present. I'm not going to do a pitch because I hope I'm not a deal sponsor ever again. But I do know some of my partners who have open deals right now that could come and pitch. So just let's start putting together a list of people we want to come and pitch, and maybe we could give them like 20 to 30, like give them 20 minutes and they'll talk for 30, right? And then kick them out, and then do start analyzing actual deals. Like maybe John could join us, or we get Derek in occasionally, and just crack open the deals and just start looking at them.
Emma, do you know if you guys can be, as an entity, a joint venture? I mean, we're talking syndication, but can you be a JV, do a JV as the entity?
Yeah. Or you mean the entity that we go into the general partner with?
It wouldn't be a general partner, it'd be a joint venture. So if I connect you with the JV group, where it's you and Gary, your entity and Gary are the new entity.
So forming an LLC together, or just using a joint venture agreement between two existing LLCs?
Yeah, joint venture would be fine, I guess. Yeah.
I think it depends on it probably depends on the deal. I'd have to ask my attorney how that would look. My attorneys tend to not like joint ventures for these kind of things because they're so big, even if you only have 2 or 3 people, just because the deals are big. Every time I tried to do a joint venture, my attorney, and I have different attorneys, they always are like, you really just want to start an LLC for this, or even an SPV LLC. I've never actually, I'm trying to think. The only joint venture I've ever done are like with my earnest money partners. I've never done a strict, like, and by joint venture, I mean like the legal structure where I have my LLC, you have your LLC, and there's just a joint venture governing agreement between the two. I've never done that on an actual deal.
Because if you're an entity, I'm thinking, and you're a bunch of individuals in an entity, in a joint venture, you can't look like a syndication. So the entity has to have jobs in that joint venture, right? Again, so, but if you have 6 people in there, now how does that work? I was just curious. Yeah, maybe something to ask your attorney.
Well, as far as that goes, as long as everybody in our micro group has a job, because we're vetting deals together, choosing deals together, nobody's making decisions on your behalf. Once we go in as a general partner, only one person has to have a job in the new GP.
Okay.
And then they're just acting as the fiduciary for the rest of the group. But because the rest of the group aren't limited partners, it's solely kosher. Now, this is being recorded, and if I'm wrong and you're an attorney, please tell me before I do it. So this is all ideas. This is all theoretical. If anybody has said anything incorrect and you're watching this recording later, like, we want to do it correctly. Like, if you have information and you can guide us, like, come into the club, you know, we'll pay you, right? Like, we want to do this right. So, but that's the what I've been being told, is that the group itself has to have a job in the GP, and that can just be the managing partner or the fiduciary of the group doing it. Or I could say, hey, I'm the fiduciary of this group because I put it together and everybody's newbies, but this person over here is really good at finance and she wants to do financial auditing or whatever. Then she could have the job and the rest of us could be just watching. And as long as we have a voting position and we get a say in what's going on, then that should be enough. But I'll double check all this. Good questions. We don't want to make it scary. All right.
Yeah, I have a question. So Emma, I think like Melanie was saying, I have done some syndications in the past, but I haven't done like a personal investment, like a multifamily thing. So is there a way we could look at some existing or the old deals to get an idea of how it will look like?
Yeah, like sample deal packets.
Sample, yes.
We could look at some live deals and it's going to be very similar. We don't have to invest in them, but I have some old stuff, like stuff that I've sponsored. We could just pull open a packet from somebody who sent me something, you know, before. In this case, I don't think it makes a difference if it's live or if it's old. If it's the one benefit, if it's old, is we might be able to compare pro forma to
and how it performs. Okay, makes sense.
Yeah, right. And I don't know, because that information is, I don't think proprietary is the right word, but confidential. So for example, let's say you invested in a syndication and you could show us the pro forma when they first pitched you on it, and then a year later you could actually be pulling out financials and comparing that to the pro forma. I don't think you would be allowed to share that with us in a public way. So it would be really interesting, but I just think it's confidential work product.
I see. Okay.
But you could ask the operator, probably. If we wanted to do that, the operator gave permission, or if the operator has to be very careful, because if they come in and do a public pitch and they say, here are the actuals, here's the actual return that we got based on our pro forma, that's actually a securities violation. They can't tell us specifics after the fact. Again, correct me if I'm wrong on that, but I know when you're talking about it in public, you can't say we got 19% returns on this deal, because then that's kind of conditioning the market that you're going to do that next time. And so they have to be very careful about what they're saying and how they did on specific past deals. I know there are a lot of rules around that. So this would be
we'll look at the live ones. Yeah. Okay. We'll look at the live ones.
Yeah, I think looking at live ones is just, you might as well, because that's what we're going to be doing eventually.
Okay.
And then if their securities attorney can clear them to come and talk to us about deals and we can do the comparison, I think that it would be interesting to look at. I mean, I have deals that I'm doing that I have actuals and pro forma that I might be able to show. Yeah, I just have to get my attorney's input onto it. And I might not be able to record it. It might have to be invite only. I just don't know. I just have to find out.
Okay.
All right. Okay, let's plan on meeting next Thursday, 6:30. I'll bring some sample deal. Melanie, you can come in and present your group. Maybe invite, what's his face? What's his name again? Invite your partner.
Oh.
I can't remember his name, the one you were telling me about. If he wants to come in and pitch with you, and it'll be a good little session to get to know, and then we can.
Lance, maybe?
Sorry.
Lance Peterson, you think? Was it?
No, not Lance. It was the other guy who's doing residential assisted living.
Oh, Eric, or I mean, there's Chris and Cedric. There's 4 partners on that, but that deal's not ready to rock. We have we have a bottleneck, but I do have one that's the portfolio of the single family homes on lease options. And that would be a joint venture. And then I would have stuff for you tonight. I had a call today. It's like, hey, we had an investor drop out. We need $500,000, and it's a decent deal, but he gave me till June 18th. So there are, if you guys could be limber and fast, you might be able to pick up some save deals and probably get some extra bumps if you can move quickly, but not time for that. By Thursday, I'll either have something for you or I'll give you a sample, I guess.
Yeah. Or just kind of give us a background on your team and what to expect. And then Paul and I are going to rock out your lease options because that's what we know. So, all right, let's meet next Thursday, 6:30. I'll post it in the group. I will bring some sort of let's give Melanie, like I said, 20 to 30 minutes, and then I'll bring a deal. I'm just going to pull one out of my email. I don't even know if I know the operators, and we'll just crack it open and start looking at it as if we were going to do it.
I recommend watching webinars, just showing up and watching webinars. You learn so much.
That's true, because a lot of these will have webinars that are recorded. So maybe I can do some preparation by finding a deal in my inbox and getting a webinar replay that I can send out for people to watch before next week's meeting. Because then when we crack open the deal, well, we should have maybe already watched the webinar, because those are really informative. And they'll walk through the pitch deck page by page and answer questions. So that's a really good idea. I'm going to do that. Okay, so I'll send out a webinar in the group. I'll pick some sample deal. Melanie will come and chat with us from an operator perspective. And we'll try and keep it to like an hour, like 20 to 30 minutes with you, and then 20 to 30 minutes of cracking the deal open. And that way you all can get to bed on time. Awesome. All right. Well, thanks for everybody who's stuck around. I think we're down to 16 from 40. And invite people, especially if you know those people. They're like frustrated general partners. They've got like 50, 100, 150 grand, and they're like, I just don't even know what to do. I think that's a perfect person for this type of club, at least to start out with.
Sounds good.
Awesome. All right.
Thanks, Emma.
Okay.
Thank you. Thanks.
Stop the recording. All right, Don. Thanks for coming. Alma.
Thank you very much. See you guys.
Thank you.